So I welcome you to the income tax management session for ag producers. And we usually get a little mix of tax preparers and producers. So we're happy to have you on today. So with that, we'll start in our order on our that we have on our agenda here. Our first presenter is Alan Gregerson. He's the stakeholder liaison for the IRS. He had previously held positions in the IRS as a field examiner and a tax preparer service specialist. He's based out of Bloomington, Minnesota. And he's got a bachelor's degree from the University of Minnesota, and has spent 38 years with the IRS.
Thank you very much, Ron, for inviting me again for the presentation here. Like Ron mentioned, I'm Alan Gregerson. I'm with the IRS for 38 and a half years, actually. And we're going to go over some important information. So being a stakeholder liaison means I do a lot of presentations and also listen to any concerns that people have. Let's say the practice, policy, and procedure isn't really working the way it should, say in farming issues or other issues. I want to know about it because I elevate those issues. So it's kind of a two-way where I do outreach and I also listen to practitioners and taxpayers' concerns that maybe something needs to be elevated for the business owner in the IRS to know. So we're going to talk about tax updates. We're going to talk about information returns, filing, and breaches and scams. This is kind of like Cyber Monday, and it's always good to remember about breaches and scams. So we'll have a little bit toward the end of the presentation. So with that, there's my email, alan.j.gregerson@irs.gov. So if you're a practitioner or a taxpayer and something is just doesn't seem right, send me an email on it and say what the specifics are, and we can maybe see maybe it's an issue we need to elevate on it. But again, I'm a helpful IRS. I'm not an audit. I'm not in collection. I'm in communication. So our point is to help people comply with the tax laws. So that's my purpose. So we'll talk about the IRS tax updates. We'll talk about this clean energy, home and residential credits for builders, energy efficient commercial deduction, clean energy provisions to start with basically on it. And JC also has some additional stuff on it. So I'm just going to kind of hit the highlights here in terms of that. The information that you have on the slide is good information, and you can use it to refer back in terms of there's some useful information to see where information is coming from or links to do your research. So we'll talk about those basically, the clean vehicle credits basically on it. So when we start talking about these energy credits, they subsequently renamed them clean vehicle credits basically in terms of that. So we might have heard different terms for it before, but they named it clean vehicle credits. They added fuel cell vehicles and electric drive motor vehicles provided. And we'll talk about those basically on it. So we're talking about plug-in electric drive motor vehicles. A lot of people, when I go to different trade shows, they say, well, does hybrid work? No, hybrid does not work. These are plug-in vehicles. You actually plug them in basically to recharge them. So again, we added fuel cells to this also. And here's different code section. There's previously owned clean vehicles, which basically are about half the credits of the new vehicles in terms of that. The criteria is kind of like half, so we don't really go in a lot of detail on that. And qualified commercial clean vehicles, and we'll talk about that. That's 45W of the Internal Revenue Code. Okay, in terms of this, the clean vehicles purchased in 2023 and after, there's something for before, but I figured and get a lot of questions on it, but you could research that. But they could qualify for a credit up to $7,500 basically if they buy a new qualified electric vehicle. Now, qualified electric vehicle is a term, basically a tax term on it, and you have to meet certain criteria on it, and we'll talk about that. Now, the Inflation Reduction Act, or also called IRA Act of 2022, changed the rules for credits purchased from 2023 to 2032. This is now referred to the new clean vehicle credit. So it's in effect in the law for a number of years. So if they didn't purchase it yet and they do want to purchase it, they still have time in the tax years. Now, again, as we speak, this is what exists at the current time. Could be changed, could be refined, who knows? But as we speak right now, that's what's in place. To qualify, they've got to use it for their own use, not for resale, used primarily in the United States. They have to be their modified adjusted gross on income cannot exceed 300,000 for married filing jointly couples, 225,000 for head of households, or 150,000 for all other filers basically on it. Now here's kind of a nice star there to remember. And people ask me about this a lot. Taxpayers can use their modified AGI for the year they take delivery of the vehicle or the year before, whichever is less. If their income is below the threshold for one of 2 years, they can claim the credit. So people kind of looked at that because I know a number of people were not able to get the credit. Remember, it's a dollar for dollar reduction basically because of their income 1 year maybe jumped up. So it's good to know that a little bit. Again, they talk about the battery capacity basically made by a qualified manufacturer and had final assembly in North America. That would be Mexico, Canada, or the United States. So when I was at different auto shows, many of the vehicles are assembled in other places, foreign countries. It doesn't work basically. Also, their value might be too high that it didn't qualify. So a lot of them didn't qualify for that credit basically in terms of that. Again, a qualified manufacturer. Now, you could have a foreign car made in the United States. That's possible and meet the criteria. So that's possible too. But many of them were assembled in a foreign country. There's also a good link basically, www.fueleconomy.gov. This is a list of eligible clean vehicles can be found at that. Many of the different things on the Inflation Reduction Act they may refer you to Department of Energy or other agencies because they may have some guidance on certain ones. The IRS is in the middle of it because they have the tax credit, but sometimes it refers you to different areas. And this one is kind of refers you off the IRS website. But again, that helps you in the clean vehicle so you know which one does qualify. Again, the taxpayer buys a vehicle, the seller, the dealer basically, and they know what they need to report. They report the required information to the IRS at the time of sale, and they're required to do the taxpayer's identification number and a number of other details to make sure that you do qualify. So they send information in, just kind of like information returns that you get from banks and mutual funds and stock brokerage. It's matched up basically on it. So if people get one, we're going to be matching this information up here. Again, there's a limit on the price of the vehicle. Manufacturer's suggested retail price, or MSRP, can exceed 80,000 for vans, sport utility vehicles, and pickup trucks, or 55,000 for other vehicles. Now, I want to caution you on the MSRP is the retail price of the automobile suggested by the manufacturer, including options and accessory and trims installed by the manufacturer, not the dealer, but by the manufacturer. It excludes destination fees. It's not necessarily the contract price. So if we go in and buy a vehicle, we're looking at the MSRP. Now, you may not pay 80,000, but we're looking at the MSRP because that's the only way we can really look at it, because all prices kind of vary that people pay for vehicles. So we just look at the MSRP to see if it meets this criteria that it is in the price that it can't exceed. Again, the credit for, you could use these links basically in terms of that. On that, electric vehicles with final assembly in North America. They use a VIN, the vehicle identification number decoder tool, to see where it's assembled basically in terms of that on the Department of Energy. So a lot of information here in terms of the vehicle's weight, battery capacity, and final assembly location is in that VIN information. Again, they look at the battery capacity basically. So the 7,500 credit is broken down into two factors, 3,750 and 3,750 on the battery components, where it's manufactured or assembly, and the critical minerals. So keep that in mind. Here's the credit for what they send to you. The dealer must provide specific information to the taxpayer purchasing the clean vehicle. Once again, must provide that. So you go into a dealer, it can't go to a private party. It's a seller, basically, a dealer. They'll tell you the name and taxpayer identification number of the taxpayer, because we're going to match those up. The VIN number, battery capacity, verification, the taxpayer's original user, the name and taxpayer identification number of the seller, date of sale, sales price, maximum credit for the new clean vehicle being sold, and the amount transfer credit applied to the purchase under the penalties of perjury. Now you can also transfer it back to the credit and credit back to the dealer basically on it here. So this is a credit that can be transferred back, but I'll leave that for a little bit more detail. But if you are going to buy one, transfer it, you can ask them about it. There's much information on IRS about that. But you file a form 8936 basically to claim the new clean for vehicles placed in service 2023 and later. The taxpayer will provide this information to us. Even though the dealer is providing it, you also provide this on that form 8936. And the key thing is, when is it placed in service, when it's available to be used. That's the key terms in terms of that. So again, that's the commercial vehicle. Excuse me, that's the credit for clean vehicles, 7,500 for qualified vehicles with gross vehicle weightings, the GVWR, under 14,000 pounds, and 40,000 for all other vehicles. So those are your large vehicles. You may see those delivering a lot of product out there. So that's the credit available to that. So it can be businesses or tax exempt organizations that buy a qualified commercial clean vehicle of 40,000. So we could have a tax exempt organization, city, county, school district, or something like that, that could purchase it basically on it. So again, up to 40,000. There's no limit on the number of credits. So like the personal one, the 7,500, people ask me, well, if I really like it and buy two cars, am I able to do that? Sure, you can do that. It's not limited to one car per year. So if you wanted to buy two or multiple, basically, there is no limit on the 7,500 or the commercial one. Now, the bottom line is, though, you've got to have tax payment, so to speak. So when you do your return, the tax liability. So if I'm going to take a credit for it, buy it, meet the criteria, I have to have at least $7,500 in tax for the year. That's my tax liability, because then I'm taking the full credit of $7,500 against it. So that would leave my tax at zero. Now, if I tax liability of $3,000, I'm not going to get the full credit, because it's a situation where it's non-refundable. I have to have tax paid basically to get the credit. So again, if I had 15,000, yeah, I could get two credits if I had 15,000 tax liability. So for businesses, the credits are general business credit, non-refundable. Again, like the 7,500 we talked before, they cannot get more on the credit than you owe in taxes. However, the business credit portion can be carried over to a subsequent year, that when you do have enough tax liability on it in terms of that. The vehicle's got to be subject to depreciation, which most vehicles are, be used in the business, primarily in the United States, and not have been allowed a credit under those sections on it here. So again, it's important to know those. It's a motor vehicle. under the Clean Air Act, basically on public roads or mobile machinery is defined under that code section. Again, the plug-in vehicle draws significant from an electric motor with battery capacity on those, or a fuel cell motor vehicle on it here. Again, important criteria for those commercial vehicles. And you can look here at the www.irs.gov/clean vehicles for updates in terms of that, claiming that credit. Again, for commercial clean vehicles, that's the 8936. Again, that VIN number will be reported on 8936 along with the make, model year, and placed in service date, which is key basically. And the depreciation of the vehicle is reduced by the amount of commercial clean vehicle credit. Here is some important information in terms of that. You want to know about clean vehicles, frequently asked questions on new, previously owned, or qualified commercial vehicles publications. 5724 for previously owned vehicles, 5724A credit for clean vehicles, 5724B for commercial vehicles, 5724D for previously owned clean vehicles, 5724E credit for clean vehicles, a poster, and 5724F credit for commercial vehicles. So again, those websites are good basically to get some additional information on it. I'll just touch over the residential and home credits. Now there's two of them basically on it here. The efficient home energy improvement credits, 25C is in the code section. Residential clean energy 25D, two different code sections doing two different things. The energy efficient is trying to make your home more efficient in terms of energy. Clean energy is using clean energy. So they're two different. Sometimes people get confused on it here in terms of that. So the two components of the inflation reduction. Again, the energy efficiency, home and credit, it's for homeowners, renters, or a second home used as residence. So it's not available to homes that you don't use as a residence. So that's an important criteria that people ask. Again, the energy efficient one, there's a 30% credit of 1,200 annual credit limit. Again, it's an annual credit limit. Remember the other ones before? We used to have years back where once you took that amount, you hit that maximum, you were done basically. This one has an annual credit limit. Again, it's 30% credit. It's a tax credit, basically up to 1,200 for qualified energy improvements for the building envelope. We'll talk about later in residential energy expenditures during the year, and home energy audits. We'll talk about that. That maximum's out at 150, but again, that's kind of a written appraisal by a qualified appraiser, and we'll talk about that a little bit later. There's also the 30% credit for a 2,000 annual credit limit for heat pumps and heat pump water heaters and biomass stove boilers. So you see that from is on or after January 1st, 2023 and before January 1st, 2033. Again, you're kind of stacking these. You've got a potential credit of 3,200. Now, again, it's you're going to have some tax on it, but the building envelope, your windows, your doors, your skylights, your insulation, your ceiling materials to make the home more efficient, residential energy in terms of central air, water heaters, furnace, boilers, panel boards, and the home energy audit, which caps out at 150, that specific one, and the other one for the heat pumps and water heaters and the boilers, 2,000 maximum. So you could potentially have a $3,200 credit, basically. Again, here's kind of the thing. There's a limit on windows and skylights, 600 across all windows, doors, 250 per door, 500 across all doors, and the insulation, no property specific limit basically in terms of that on the specific insulation. But again, there's an upper limit on it. There's some links. You've got to meet these Energy Star, most efficient ones, or Energy Stars. So you're going to have to meet some criteria. Insulation, the most recent International Conservation Code as of 2 years prior to take the credit. So that's kind of the criteria they look at. The most current one within 2 years for insulation. Again, here's kind of the limit per water heater or furnace, basically, in terms of that. And you can see the links there. Electric panels got a 600 cap on it, basically. Also an air conditioner, 600. So if we buy one larger, we're capped out per air conditioner unit. So there's a cap on the specific one. There's also an upper cap, basically, in terms of that we can take. But again, potentially there's some nice things there available if you're thinking about, well, we had some central air conditioner, we're gonna replace it. We've got a good credit there available to, at least for part of them. The insulation, again, if we have home energy audits, it's inspected by somebody, a qualified appraisal written report, and located in the United States. So again, those are all for the energy efficiency here. The water heaters have the 2000 limit in terms of the heat pumps, basically, and they talk about the thermal efficiency rating that you need to meet or the efficiency on those. Again, the recap, it's exterior doors, windows, skylights, insulation materials, basically, on it here. The clean energy one, that basically is to choose renewable energy that can lower monthly energy and cut air pollution, basically. The renters are eligible for certain improvements, and it's based on the property equipment purchase, basically, on it. So again, depending on what we do, the residential clean energy credits, 30% for certain qualified expenditures for residential clean energy credit. In terms of that credit starts phasing out in 26%. So it starts at 30 and until January 1st and before January 1st, 2035, if you've taken it, but it starts reducing it in 2033 to 26, 22% in 2034, and no credit after December 31st, 2034. So it kind of tails out as the latest years come in. Again, that's those residential clean energy credits for solar credit, solar water heating, solar or small wind energy, geothermal heat pump, fuel cell, and battery storage technology, basically, on it. So that's the items that are under the residential clean energy credit again. So you would be talking about your solar panels, your solar water heaters, fuel cell property, small wind energy property expenditure for wind turbines, geothermal, battery storage, basically, in terms of that. Again, just talks about this a little bit more, the 30% on it here. In terms of that, the water heating has to meet the Solar Rating Certification Corporation or a comparable entity, or the Geothermal Heat Properties Energy Star program again. Again, here's kind of a summary here in terms of that. Home in the United States for the energy efficient owned and principal residence, basically. Home in the United States, existing home and renovation. Solely used for business. There's no credit for the energy efficient home credit. The residential energy is existing home or newly constructed home and solely used for business. There is no credit. Again, it talks about that owned and rented and used as a residence here. Again, the energy efficient one, you include the preparation, assembly, and original installation. Do not include labor costs for qualified energy efficient building envelopes, including insulation material, exterior, skylight, and doors. So labor costs are not part of that credit. In the residential clean energy, again, those solar things, labor costs are allowed, basically, in terms of that. There's kind of a lot of things that need to be done to make that solar or wind active, basically, in terms of, here's some additional one. Begin the rebates, reduce the cost by rebate. If there's a public utility, got to reduce the cost by the amount of subsidy, basically, on it. So it talks about different action if you get additional amount for these energy credits in terms of that. Again, the timing basically in terms of the energy efficient, you can't carry it forward. The residential clean property credit, you can carry it forward. Yes is the answer in terms of that. Again, here's the form, residential energy credits, 56.95. This is the 2022 one, but again, they're very similar to the one here. Again, here's some resources that you can use basically in terms of that. If you need to go and frequently asked questions about energy efficient home improvements are on irs.gov. So you see that, look at that, see what it is, document in your work papers that you saw a frequently asked question for that. If you had some question, it shows that you're looking for the material, or you look at the code section for that. Again, some additional links here. I want to make sure that you're aware there's new energy efficient homes for builders basically on it. And that's a credit 5,000 per home. They have to meet certain criteria basically in terms of, and if they meet prevailing wage requirements, is that you'll see that's kind of a thing that's in these credits for these Inflation Reduction Act. You can construct or rehabilitate a qualified home, own the home so the construction owns the home as basis during the construction, and sell it to a person used as a resident. So this is the construction one basically. It's going to be used as a residence, certified by the Environmental Protection Agency or Department of Energy. It's a single family or multi-family home again. Could be a credit for the contractor from 500 to 5,000 if they meet these criteria, and also the prevailing wage requirements from the U.S. Department of Labor in terms of that. Again, here's the criteria that they need to meet basically for the contractor. So again, this is some additional information, Energy Star Residential New Construction Program. You can see that link. And of course, the credits basically in terms of that, the Energy Efficient Home Credit 45L. There's also part of the Inflation Reduction Act, Energy Efficient Commercial deduction basically on it here that could be schools, churches, hospitals, other buildings basically, and in terms of that. It's got to be in the United States. This is a code section 179D basically in terms of that, that talks about that. But again, it could be interior lighting systems, heating, cooling, ventilation, building envelope must be certified as being installed as part of a plan to reduce the energy and power of the above system by 25% or more. Again, in these qualifying buildings, these property here in terms of that. Again, it could be as part of the lighting systems, heating, cooling, ventilation, and hot water, and the building envelope. And the standards must be measured about the latest standards at least 4 years before the property is placed in service. So we have to meet those criteria. Again, certain tax exempts are allowed to allocate the deduction to the designer if they want. In terms of that. So if there is some information, must be in writing, contain 8 elements, follow that notice 2008-40. Again, there's other resources, irs.gov, of course, but Department of Energy on it here. There's also all these credits. So we mentioned clean vehicle, commercial clean, previously owned vehicle that is available. Those are all the code sections. These are all part of them. So they're different code sections that deal with certain things. So if you're looking at production tax credit, that's 45Y and 45, but other ones, energy efficient home credit, 45L. So you see they're all kind of different ones, and you can look at the code section on it, but that kind of does. But what you have to do basically, if you're looking for these credits basically, in terms of that, there's a registration process of for these vehicles, basically, in terms of that. For elective payment election, we're transferring it back to a dealer, basically, in terms of that. But again, there's a pre-registration in terms of that. In terms of that, they include tax exempt organizations, 501A, 501C and 501D, state and political subdivision, or local governments, tribal governments, Alaska Native corporations, rural U.S. territory governments that qualify for these elective payment credits that we're seeing that we need to register. So they have to be approved basically to see if they qualify that. So if a tax exempt organization, they're going to have to get it on a 990T. They maybe don't file one normally, a tax exempt organization, but they have to file it. And there's a certain service in terms of it's got to be placed in service before a registration at the IRS will be given. And you complete the pre-filing with the IRS. But basically, it's got to satisfy all the criteria on it here in terms of, so we have wind and solar 45E basically. We'll just talk about that really briefly. If you put it in a low income community bonus area, the credit on those business credits we just talked about or had listed basically, there's bonus that it qualifies for a higher amount in terms of that. Here's the application process in terms of we're doing wind and solar. In terms of that's placed in service, the IRS reviews it, Department of Energy reviews it, they give you a review, and they give you a determination basically in terms of that. So you have to go in and register to complete this registration if we're looking for those credits again. Here's some about the prevailing wage and low-income business bonus in terms of that for the credit. It talks about that and prevailing wage and apprenticeship. So that's kind of really a quick one in terms of the energy one. I want to talk about some of the employee retention credit updates. There's some key things on the employee retention credit. Again, as far as we know, the program was in place on November 22nd, but we're waiting to hear if they're going to be extending that. I've not heard anything recently in terms of that, in terms of the withdrawal process. But here's what we had is that if you did apply for the employee retention credit, and you found, well, I didn't really qualify, there's a process you can withdraw that full credit and meet certain criteria. These are the IRS guidance on them in terms of that. IR is the IRS release 2024-30. And if you came into the program, withdrew it, you had to do certain things, you didn't get a check, or you haven't been audited, you'd have to pay back the employee retention credit. This was a credit for because your business was shut down or your gross receipts decreased by the government, shut down by the government, or the income decrease basically allows you to come in and take out that employee retention credit or withdraw it basically. If you did it recently, there's a 85% payback. If you came back, you had to pay back 85% of the employee retention credit. If you have a payroll company, there's the IR 2024-246 that talks about what you need to do. And if you wanted to know the update, the latest we got was IR 2024-203. August 2024, it came into that in terms of that. So you would usually got the refund if you they were looking at it and qualified, they got a refund. They may be auditing basically. A number of things may be happening, but that kind of updates you basically in terms of that. But again, they found out the earliest ones were pretty good, but as they got toward the later, there was more that didn't meet the criteria, and they weren't entitled to the credit, so they had to begin auditing that to make sure everybody qualifies for them. Marijuana IR 2024-77 on the IRS level, and that's the code section 280E. That's a controlled substance still. It is still legal on the federal level, which means you still can take cost of goods sold against that in the situation, but not other expenses basically in terms of, so it's still a controlled substance on the federal level if you're, even though some states may have different rules on it. Again, 72T in the Internal Revenue Code. This is the section with the 10% penalty. There's the IRS Notice 2024-55 and IRS Notice 2024-28 that you could go to that. basically allows you to get money before you remember they had the 10% penalty for medical care, casualty, and accident loss, foreclosure, eviction, funeral expenses, auto expenses, and domestic abuse up to 10,300. So used to be limited one. It seems like they're getting more and more reasons you can take it out of the plan, basically in terms of the pension plan, not be subject to the penalty. Again, those are specific notices that address that basically. The 1099K, kind of unique where we had that out there that if you were online basically and or a payment card basically had $20,000 or 200 transactions, you get the 1099K basically. So what they are now saying per notice, IRS notice 2024-85 is talking about that it's decreasing for 5,000 in 2024, 2,500 for 2025, and 600 to 2026. So we originally thought it was going to be right away at 600. They kind of phased it in. So again, 5,000 for 2024, the 1099Ks can be issued, 2,500 in 2025 year, and 600 in 2025, 2026, which would be filed in January of 2027. Again, there's going to be information returns. Again, it's 10. We add all the what you have, whether they're W-2s, 1099 NEC, 1099 miscellaneous. If it came up to all the information returns to 10 or more, you have to file electronically. But there is under the Form 8508 certain exceptions to doing that. If it's kind of like first year for the business, it's not a reasonable cost for the business. There's Pfizer casualty, death or illness of the owner, unavoidable absence, religious exemptions, administration exceptions, first year reasonable cause, business catastrophe. So if they can't file for some of those reasons, look at that Form 8508. There will be a 1099 DA, which is digital asset, which is basically for a form that if you had a manuscript or photographs or something digital, that will be issued 1099 DA in the year. For 2025 will be issued January of 2026. So you may see that because there's some assets being sold of digital nature, basically in terms of that. Again, the Tax Cut Jobs Act is going to expire after 2025. So currently we have 10, 12, 22, 24, 32 is the tax rates. We will revert back if no changes to 10, 15, 25, 28, 35, 39.6, but higher tax rates after 2025. Required minimum distributions, there's a notice on that for 2024, excise tax will not be assessed on required minimum distributions that people need to take but didn't take out. But back in 2025, I think starting that will be the last year. That will be a year that you will be start assessing taxes, excise tax if they're for the 2025 year. In information return intake system, file information returns electronic. You can file through the IRS basically on it. Here's kind of the forms that you can file. It's free basically, but if you do go on, you've got to get a TCC number, transmitter control code. Be sure whoever applies for it, keep all that information. So if they may leave, that we know all that information, the passwords. These are the information returns that they can file. And A2A modifications can really send a lot of them to the IRS with that modification. Again, here's resources on it. There's National Tax Security Weeks starting this week, and that just to remember, there's a lot of scams, identity theft, refund out there. Use only secure sites. Update your security all the time, basically. Use strong passwords, multi-factor authentication. You want to make sure you're using that. There's a lot of information on irs.gov/NTSAW basically to be safe for that. There's a lot of information, people want to get. If you're a tax preparer, they're looking for that information. Again, there's information, don't provide personal financial information on that. There's a publication 5461. If you want an identity protection pin, there's a 5461B. Business watch out scam related, basically, in terms of that. Again, you want to have a written information security plan. If you are a tax professional, there's a publication 5461D that talks about it. Just want to make you aware, if you're doing amended returns or 1310 or 56, a person dies, you want to make sure you submit a Form 56 because that's the form they're looking at. Who's the administrator executor of it? They may ask you to do the 1310. Make sure you have looked at it to see they qualify. And the 2848 in terms of that, you want to make sure it's done correctly, the power of attorney. If you talk to somebody in IRS, make sure you get their sister's name and number, their IRS number, because we can basically trace that within 45 days and we can follow it up if they're giving you bad service or a incorrect answer. So with that, I guess I'm close to my time, just kind of a brief interview, but go ahead, Ron. Is there questions
Yeah,
in?
there is a there is a question in the chat. I was going to mention, I failed to mention that earlier. You can submit your questions either in the chat or the Q&A box. And we have one in the chat. The question is, can you still amend a 2020 tax return for the 2020 ERC credit?
So 2020, do they know what credit it is, what period it's for? Because some of them have 6-year statute and some have 3 years. So if we have the 2020 tax year, that's due considered April of 2021. And so basically we have a statute of 3 years basically in terms of that. But the statute on employment tax goes for 4 years. So basically that would be 2020, 05 excuse me, that would be 2025. Employment tax have a statute of 4 years basically. If it's a third and fourth credit on the year that you're taking those are 6 years. But if assuming that's the earlier one, I would say we're okay because we have a 4-year statute on employment taxes.
Any other questions for Alan? And you can see he's got his contact information. I'm sure he'll always, you can always email him with a question later on.
Yeah, just say you saw me at the virtual presentation for North Dakota State University, and I'll gladly to help you out on any questions on it. With that, I think I'm done here, right on time here, Ron. I think I'm going to listen for one more section, and then I have to leave for another presentation. So,
I guess we have one more here.
okay, go ahead.
While I have you, can you amend the individual 1040 for that credit, not the employment return?
Well, you can always amend a 1040 in terms of that. So that withdrawal process was just because of the employee retention credit. So if you have some other reason, yeah, you can amend returns for other reasons. That was just for the employee retention credit program.
Our next speaker is Rob Holcomb. He's the extension educator at the University of Minnesota. He works on development and delivery of educational programs on ag risk management. He's been an instructor for the Minnesota income tax course since 2010, and in 2011 he began serving on the tax school faculty director, serving as the faculty director. He has a master's degree from University of Minnesota Duluth. He is also one of the people that works with the IRS in developing the publication 225. He's based out of Marshall, Minnesota. We've had him as a speaker before, and we're gonna have you one more time here, Rob, and go. I guess it's all ready to go for you. Go ahead.
Okay. All right. Thanks, Ron. And but what Ron assigned me here, I'm going to be upfront. I'm going to have to go kind of fast on this. I'll try to focus on the important stuff, but I do have a lot of stuff to go through here by 2:30 to stay on the agenda. Now, I'll have my contact information here at the end, but as far as the material that I'm drawing from here today, uh, good portion of that's coming from Land Grant University Tax Education Foundation materials. Those are the materials we use for our 2-day tax courses. Plus, we do an all-day ag tax course. Also pulling some stuff from ruraltax.org. That's also known as the Publication 225 Committee. They have that website is located there. There's a lot of beneficial information there. Plus, just pulling some stuff from IRS. Now, in my time today, what I was asked to talk about was to give you everybody a little bit of an update on this Corporate Transparency Act beneficial ownership reporting. I will go through a little bit of that. Also, Ron asked me to talk a little bit about the soil fertility issue, and we'll get more into that, as time goes on. But plus, we have a number of expiring provisions that we're looking at, and this was a result of passage of the Tax Cuts and Jobs Act back in 2017. There's a lot of those provisions that are set to expire at the end of next year. So we wanted to talk about some of those things that are set to expire. Now, some of that could get extended with post-election. Whether that's going to happen or not, I'm not going to speculate on that. But we'll at least talk about the stuff as it stands right now. Plus, I want to go through some fall tax planning tips for everybody. So ambitious schedule to get through by 2:30. So let's talk about this beneficial reporting stuff that's going on now. This and this has been in, holy smokes, Farm Journal, and it's been in all the farm publications. It's been on the news. It's been all over the place. You'd really have to be almost living on another planet not to have heard about this, because it's really been talked about quite a bit. Now, why are we doing this? Well, this information reporting came out of the Corporate Transparency Act. It's something that's been on the books for several years. This was something that was passed by Congress, and essentially what this reporting is for, it's reporting that's required of certain entities that are out there, both farm and non-farm. And the whole idea is it's trying to combat money laundering. That's the whole, that's 99% of why this is out there. Is it's trying to find people that are hiding money in all these entities that are out there. Now, Ron probably distributed. I had a PowerPoint that I PDF'd and everything, and those you should be able to cut and paste out of those links out of that PowerPoint. But if you're needing to dig into this a little bit more, there's a couple of links on this resource page. There's a small business entity compliance guide that I would highly recommend. If you think you're on the hook for this, that's probably the place to go, because that's really, not to be sacrilegious, but that's kind of the Bible for all this BOI reporting stuff. Now, the whole issue that we want to talk about here is who's on the hook for this reporting. If you have an entity that you had to go to your Secretary of State for creating that entity, then it's going to be subject to reporting. All right, it really can't make it any simpler than that. So when you look at this, like the top line, we'll spend a little bit of time on this. So if you have an LLC, in order to create that LLC, you had to get a charter from your Secretary of State. LLCs are a yes for having to report for this. A single member LLC also has to go to the Secretary of State for that charter. They're going to be subject to the reporting. All right, now if you just got a family general partnership, and you've never incorporated it, you've never done anything, you've never done anything beyond just the general partnership, no, you're not subject to reporting. Same thing with a sole proprietorship. Sole proprietorships are not on the hook for reporting on this. Now, a limited partnership, if you got an LP, to create the LP, you had to go to the Secretary of State. That's going to be a yes. S corporation, same thing. You had to go get it. They said there's charter paperwork that has to be set up with the Secretary of State. Same with a C corporation. Trust, you need to look at North Dakota. You need to look at your individual North Dakota pieces for that. Rely on your legal counsel for determining whether or not that's there or not. Now, the most common question that I'm getting on this beneficial ownership reporting, and I think I had 5 of them show up in the email this morning, is and a lot of them that I'm getting are coming from the farmers market people. What you've got is you've got a sole proprietor that registers a doing business as, registers as a DBA. Those in Minnesota get registered through the Secretary of State. Now, through the language in this thing, they think, oh, that means I have to report. No, they don't, because the doing business as does not create a new taxable entity. This is an individual that's still filing as a sole proprietor. They just have a different name that they're registered. All right, that doesn't qualify for an entity. Now, there's folks, there's 23 different types of businesses that are listed here, and if you're needing to dig into this a little bit more, I'd reference you back to that guidebook that I had the link for earlier. That's where this chart came from. It was cut and pasted out of that document. So this long list of items that you see here, it's impressive, but you're going to be hard pressed to find common businesses that are going to be exempt on this. Tax exempt. I get questions on tax exempt all the time. The only real tax exempt that I've found that's excluded from this are going to be your 501c3s. I'm treasurer of our Ag Agents Association for the University of Minnesota, and we're a 501c5, and we have to report. All right, I've got to do a report before the end of the year on for our Ag Agents Association. Now, here's kind of the deadlines on this. All right, if you had a qualifying entity that has to report under this, all right, and it was in existence before January 1, 2024, you got till the end of the year. All right, you got till January 1, 2025 to get that rascal filed. All right, I wouldn't wait till January 1. I would do it before New Year's Eve. But that's the whole deal. If that entity was already in existence, you got to get that thing filed before the end of the year. Now, if the entity was created during the course of the year, and we'll get to that here in a moment. I'm sorry, I'm getting a little ahead of myself. Some other reasons why you might not have to file this thing is if you've got a qualifying entity and it's been inactive. All right, and when I say it's inactive, you got to meet every one of these 6 criteria that you see on the chart here. So it had to, it gives you the entity was in existence before date, and and it gives you all the criteria. You got to meet every one of them. All right, got to meet every one of them to have that be inactive. So deadlines for the BOI reports. Now, I mentioned this already. If the entity was already in existence at the start of this year, you got till technically January 1, 2025 to file that initial report. Right. If you created something that qualifies during this year, you got 90 days from the date of creation to file the report. All right. So, and once we get into 2025, that 90 days turns into 30 days. So once we get into 2025 and you create, for instance, if you were to go out and create an LLC, you'd have to do the initial report within 30 days. Now, the part of this that's a little bit troublesome for tax professionals that might be doing one of these things is once that initial report gets filed, if something changes with the organization, the ownership changes, there's a number of things that can possibly change. When people file these things, they need to. In fact, what I've got to do for the board members for our Ag Agents Association is I got to get a copy of everybody's driver's license, and I've got to upload a picture of everybody's driver's license on this thing. Now, if the ID number on the driver's license happens to change anytime in the future, well, I've got to file an updated report. Or if somebody on the board changes, I've got to file an updated report. So for my situation, every year we install new officers, I'm going to have to do a report every single year for our Ag Agents Association. So question is, who's a beneficial owner? And we'll get to that here in just a moment. But for all the beneficial owners, you have to have the full legal name, the birth date, and a complete address, and that needs to go into the reporting form. Now, for the beneficial owners, this is defined as folks that have substantial control or own or control 25% of the more of the company. All right. So if you got anybody that's a 25% owner, automatic slam dunk, they need to be included in the report. All right, folks, the penalties for this are real. All right, it's currently what's happening with this is we're looking at $500 a day for for non-filing these things. So that's what's got everybody kind of in an uproar about this, is that it's really critical that if you have that qualifying entity, you want to make sure you get that initial report in here before the end of the year. Now, just to address a couple things here, there were some court challenges to this, particularly there were more court. We could talk for an hour on just all the court challenges, but the one that probably got the most press was this one out of Alabama, and because essentially what the lawsuit was indicating was that Congress exceeded its authority by requiring this reporting, and the judge did issue a stay. Now, what's the impact of that? All right, the impact is BOI reports are still required of everybody except the plaintiffs in these cases. All right, the plaintiffs in these cases that had stays, they have they're basically they don't have to, they're not required to file by the deadline, but everybody else is. All right, so I want to make sure that's really clear with everybody. Now, tax professionals out there on this, just kind of wrapping up this discussion, but tax professionals, I think the main thing that we really need to emphasize is that you need to identify the people in your book of business that need to get these things done. All right, if you're a sole proprietor and you're not sure, you need to talk to your tax professional, see whether or not you're required to file these things or not. Now, I didn't clutter up more slides in this presentation because we were already really full with it. But a couple things that you're going to find that are challenges about this is that some of the concerns that tax professionals are going to have with filing these things is that some states consider filing these things a practice of law. Now, I am an enrolled agent. I'm credentialed to do tax returns. I'm credentialed to represent folks in front of the IRS. I am not allowed to practice law. I'm not a lawyer. All right, it's that simple. So depending on the state that you're in, tax professionals might not be able to file these things. The other problem that we've got is most of us that are in the business, we have errors and omissions insurance that we carry on our practices. And a lot of our errors and omissions insurance have just flat out said, if you do these things, we're not going to cover you for it. All right, so there's a huge liability out there. So don't be surprised if a lot of tax professionals aren't willing to do these things. All right, so let's drive on here to a second topic that I've got here, and this is the expiring provisions. I'm not going to spend a lot of time on that. I guess, Ron, was there a new question on the BOI before I get to rolling too far?
Yes, there was. when a beneficial owner updates their license upon expiration, but the ID number stays the same, do you have to do an updated BUI?
If the ID, if the number on the driver's license, like for instance, I can't speak to North Dakota, but when I renew my driver's license in Minnesota, my number doesn't change. That by itself is not going to require any kind of a change. But if they happen to move, all right, if this person moves, it requires a new filing. All
Okay.
right.
So if your address changes, you have
It,
to update, but if your picture changes for a new license, that doesn't
right.
make.
Well, if nothing changes but just a new picture, no,
Yep.
you don't have to update it. But if
Right.
but if they move, for instance, like when I retire, if I move to a retirement community, yeah, I'm going to have to update. I'll have to update all my stuff that I happen to be tied to.
Okay.
Okay. Thank you. Uh, let's see here. What I want to look at here is we're going to talk about a few of these expiring provisions, and I need to kind of rock through this pretty quickly here, folks. Now, first of all, let's just preface this thing with to give you some background on this. Okay, Tax Cuts and Jobs Act was passed back in 2017. That was the huge, big tax reform bill. All right, it changed rates. Uh, it had a lot of permanent provision, but it had a lot of provisions that were going to expire at the end of 2025. All right, and the reason for that is that legislation was passed through reconciliation, which puts a timeline on the amount of time that it can last. All right, so that's why a lot of this stuff is coming up as expiring in 2025. Now, I'm going to roll through these now because now we are all aware of what happened with the election. All right. Now I'm not going to put a picture of a swami with a crystal ball and everything up here. I don't know what's going to happen in the Congress. All right. I think probably early in the year we're going to have a pretty good idea. All right. Some proponents are saying, well, this is going to get extended. Things are going to happen with this. This is something that you're going to have to watch legislatively. Currently, what's on the books is what's in my presentation. All right. I'm not going to take a lot of time speculating what might happen. Yay or nay. But some things that are going to happen here is bonus depreciation. Now that's that bonus depreciation that you can take on your capital assets. That's been in a continual phase down period. Actually, in 2025, it's at 40%. 2026 is the last year that we have that, and after 2026, it goes away. All right. Now that could get extended. We don't know. The major piece that's going to happen is if nothing gets extended, once we get to 2026, essentially we go back to the pre 2017 tax rates. All right, which is going to raise tax rates significantly from where we've been sitting since 2017. And not to underestimate it, that probably is one of the bigger impacts of any of these expiring provisions. The standard deduction, when the legislation was passed in 17, essentially it doubled the standard deduction on the tax return. So we in 18 we went from 13,000 to 24,000 for a married filing joint couple. Now, but once we get to 2026, we go back to those old levels indexed for inflation. And impact wise, I'm telling you, that's probably the biggest one of anything that we're going to talk about. Child tax credit essentially doubled with the passage of the Tax Cuts and Jobs Act. Well, what's going to happen is it's going back to those pre 2017 levels. Going to go back to $1,000 index. Probably. I'm not sure whether it's indexed for inflation or not. But the bottom line is it's going back. Okay, yes, 2026 is will be $1,000 with the old phase out. So the child tax credit significantly cut back from what we see right now. The other thing that we're going to notice here is the QBI, qualified business income deduction. Now, there's two ways that you can get QBI. All right, QBI is 25, essentially 25%, excuse me, it's 20% of your business income. All right, and that's in roundabout terms, that's essentially what it is. It doesn't affect self-employment tax, but it's a deduction off a regular tax. Now, the reason why QBI came about was that in when they passed the Tax Cuts and Jobs Act, they made the corporate C corporations got a flat tax rate of 21%. All right, well, there's no graduated rate for C corporations, just a 21% flat rate. Well, the QBI was something that they said, well, here's a carrot for everybody else, and the corporate rates were made permanent, but QBI was set to expire at the end of 2025. All right, so that's something that could go away. But there's two ways that you can get that. You can either get that through 20% deduction of your own business income, or you can get passed through QBI from a co-op if you're doing business with a co-op. The other thing that is set to expire is the alternative minimum tax thresholds. Now, when they passed the Tax Cuts and Jobs Act, what we have is we have those deductions pertaining to alternative minimum tax. All right, they raised those exemption amounts significantly for everybody across the board with the passage of the Tax Cuts and Jobs Act, which made it really difficult for folks to even be eligible for alternative minimum tax. Just as a quick reminder, alternative minimum tax is a second tax calculation that essentially we do it for everybody when we do a tax return. We calculate the regular tax and we calculate alternative minimum tax. The taxpayer pays the higher of the two. All right, is what happens, and but those exemption amounts are going back to those pre Tax Cuts and Jobs Act levels is what's going to happen. The excess business loss, you probably heard of this when they passed Tax Cuts and Jobs Act. There was also implemented excess business losses. Now, depending on your filing status, you had a dollar limit of the amount that you were able to take as a loss on a particular business, and if you exceeded that particular loss amount, it converted it into an NOL, a net operating loss, which would you'd have to deal with that. But 2025 was originally the last year of this provision, but intervening legislation since then has extended this provision through 2028. So this was on the horizon, but it's not set to expire until we get to 2028. Now, here's the permanent stuff. All right. The permanent stuff in the legislation from 2017, the like-kind exchange rules. All right, you probably noticed that we don't do machinery trades like we used to a long time ago. When you trade a piece of machinery, you got an outright sale of the machine that you're trading in, and you got a complete purchase of the piece of machinery that you're buying. All right, that's staying in force. Vehicle depreciation, we saw those increases for passenger automobiles. That's still on the books. NOL losses. This is not changing either. I mean, we still have a 2-year carryback for farms with an 80% taxable income limit for any year that you happen to carry back or carry forward into. The cash accounting for C corps, that's available for anybody with 30 million of less of income. Machinery, farm machinery, new machinery is still 5-year property, and we can use 200% double declining balance is what is available there. Net investment tax pretty much remains unchanged with that. So with the net investment tax is this could be available for either business income or the passive income or investment income. The 3.8% is the tax rate on the investment income. So if you've got somebody that retires, they start renting the farm out 100% cash rent, and then they subsequently sell the farm in 10 years, that sale is going to be subject to the 3.8% tax if they're over those limits. There's a 0.9% for business income, same limits, but it's it's much less intrusive on business income, as we see there. Okay, let's move on to a state and tax update here. Real quickly, moving through this, I got to ratchet it up here. Exemptions over time, as we see here, and it's not hard for me to remember back to 1997, but for current year, we're at 13.61 million. All right, for federal estate tax. Now, what this means, folks, is we just got hardly anybody that's filing federal estate tax right now. Just with a lot of cases with planning, even with the larger estates, there's a lot of stuff that can be done with that. Now, here's the key thing with the higher exemption. This is one of the things that's going to expire or is set to expire if nothing changes at the end of 2025. All right. So remember, we were at that 13 million figure here for 2024. It gets expanded a little bit for 2025. Once we get to 2026, if nothing changes, it goes back to what we're guessing is 7 million. It's the 5 million that we had on the books, but it's indexed for inflation. We're guessing it's going to be around $7 million. So something to keep on the books. It's not changing in 2025. It's changing in 2026 if nothing changes in the meantime legislatively. All right, move on here. Soil fertility. What I wanted to, Ron asked me to talk about this a little bit. Folks, this is something that I think is completely getting out of hand. I'll just give you a little bit of the background here before I run through the slides on this. This is something that's been around for probably over 20 years. It's starting to get some traction. It starts to get traction every time that we start getting some high land prices. There are promoters out here that really push this hard, and they've got some slick looking material. They just do. The problem is, theoretically, what you think is that most land is going to have say a certain level of fertility that is existing, just as fallow ground. All right, so if we do soil tests on a piece of ground and we happen to test that, test it here, what we ought to be able to do is theoretically we ought to be able to take this difference between the I guess the fallow amounts and the tested amounts, and be able to deduct as excess fertility deduction. Now, the only guidance that we have on this is from a technical advice memorandum from 1992. All right, so it's kind of old. And it's really not a good fact pattern for this. What you've got to have in order to do this, you've got to have soil tests showing the presence and extent of the fertilizer. You've got to show that it was attributed by the previous owner. You have to be able to show basis for which you measured that fertility, and you have to be able to show over time that fertility is going to be exhausted. Now, let's talk about some discussion points here. All right. One of the issues that I have with this, I have multiple issues with this. I'm most familiar with southern Minnesota, northern Iowa rates. These promoters, folks in southern Minnesota and northern Iowa, have been contacting farmers, doing soil tests, and they're in a lot of cases they're telling the farmer that they can deduct $7,000, $8,000, $9,000 an acre of fertilizer upon the purchase of ground. Now, folks, that's absurd. Farmers are not motivated to over fertilizer. They're just not. All right. Farmers, a good operator is doing regular soil tests, and they're only fertilizing what they need to fertilize. To say that there's an excess amount of fertilizer to that degree is just crazy. And once more, I've seen people that have taken this deduction on the tax return upon the purchase. And folks, what's the first thing that they go out and prepay the next fall? Well, they're gonna buy more fertilizer to put on there. Now, if they already had too much, what are they putting more on for? Other excluding the nitrogen. I mean, that's the only thing that would really make sense. So, uh, the I'm putting this down here. Minnesota Department of Revenue. That's what Mendor is. Mendor has been really aggressive in auditing these things over the last few years, and I think rightly so because this is getting abused. The what Mendor's uh, policy is that if you do have excess fertility, you can take the deduction when you can show those fertility rates going down, which is going to need multiple soil tests. But I think that's the correct way to look at this. The other way that you can do this without fail is if it's in the purchase agreement. All right. If the buyer and the seller agree that there's additional fertility in there and they put it in the purchase price and it gets allocated correctly during the sale, by all means, it'd be allowable. Now, uh, one other thing that the promoters are doing right now that I caution everybody about is, well, in fact, this is I can I'm not going to give any names out or anything, but I did a deal back in late September for the North Dakota CPA Society up in Grand Forks, and while I was there, I was presented with a situation that well, actually I got an email like a couple days before the school, and this was a sale that occurred in 2011 sale. All right. Apparently there were soil tests from back then. The promoter did some calculations. There was 600 acres in this transaction. Promoter calculated a $1.2 million deduction for fertilizer. And what they were suggesting is they were suggesting that the taxpayer take this by filing a 3115, which is a change of accounting method, and a person could amortize that expense on a current year return. All right. First of all, I think that's absolutely crazy to think about that. Now, I was a concluding remark on this, and I think Alan would wholeheartly agree with me on this. This situation is on IRS's radar. All right. In fact, Alan is bugging me to try and get me on a webinar to talk about the mechanics of this because this just folks, this is on IRS's radar. So I would be very, very cautious of moving forward with any of these slick promotional things on soil fertility. Just plain and simple. Okay. What I want to do next is in my, yeah, I got 12 minutes here, so I got to rock and roll here. I want to work through some tax planning stuff and talk you through some of the stuff on the tax plan. I'm going to get my laser pointer going here on this. Now, folks, I will say these are Minnesota numbers, but if I were to compare these, these numbers come from the FinBin database from the University of Minnesota. Now there actually are some North Dakota numbers in here. These are just Minnesota ones that oh, wait a minute. No, I take that back. North Dakota is in this. All right. This is Minnesota, Missouri, Nebraska, North Dakota, South Dakota, and Wisconsin. So it's got more to it than what I thought. So North Dakota is in this. Okay, what you're going to notice is the solid line here is accrual adjusted net farm income, which we could, I'll give you a short, brief. That's taking a Schedule F from the producer, and we're making accrual adjustments based on the beginning and ending balance sheets. All right, it's a more accurate measure of profitability than just looking at Schedule F. My point is, as we look at the line here, that's kind of the grayer one with the grayer line is taxes paid. All right, folks, every time on this graph since 2001, since every time we have a decrease in that net farm income, what do you see happen? You've got a little tick up in the taxes paid. All right, data doesn't lie, folks. All right, now that's across multiple states, but the whole point is when income is coming down on the accrual side, trying to economize a little bit. We may not be doing as many prepayments. We may not be going out and buying all that shiny paint and everything and writing it off. So that's kind of the situation that we're in right now. I mean, the current income forecast right now for accrual income for 2024 probably isn't real good, especially for especially for row crops. So what's likely going to happen is you probably got some deferred income coming through from that 21 and 22 that you still got to take care of, but current year you might not be looking real good on the cash flow. All right. Now, here's a chart that I have been using for years. Now, what we're looking at here, this is just very, very simple, but this is something I always used to print off for my clients when I was with the Farm Management Association. The blue line is our tax rates. All right, we got a 10% rate, 12% rate, jump up to a 22% rate. The dotted line is the self-employment tax. All right, we go out to 168,000 for 2024, then it drops down to the 2.8%. That's 15.3 through here. The green line is just adding everything up. All right. So what we see here is we see what that marginal tax rate is. Now, what goofs this up for tax planning is QBI, because the QBI deduction is kind of that underlying deduction, and prior to QBI, we could really rely on this chart. Now a little less so, but it's still helpful because it shows us where we're at from a tax rate standpoint. Now, if you're in a low income year, all right, all right, when you're doing your tax planning, here's some things to possibly consider. Okay, you do have the option to amortize your fertilizer expense. All right, meaning you don't have to take the whole amount of fertilizer in 2024. You might decide to spread it out over 5 years. All right, and you've got that option to do that. All right. You could also postpone expenses. All right. Now you might lose some discounts in doing that, but you can postpone those expenses, or you might want to advance the sale. Something, a sale that you might want to pull, sales that you might normally have done in 2025, you might want to pull those into 2024. Another thing to consider are the CCC loans. All right. Now they are now called market assistance loans, but that's where you essentially go to the FSA office. You have grain in storage. You decide to seal it and take out a low interest loan. All right. You've got the option of treating that as income on Schedule F. That gives you basis. You pay the tax on the balance of it when you sell that probably next year and pay the loan off. One other thing that you can do is you've had an option for several years where you can elect to capitalize your repairs, right? Spread the repairs out over several years, all right, instead of just taking all the repairs in the current year. So those are just some ideas for the low income years. Now, NOLs. Okay, if you have a net operating loss in 2024, the standard thing is to carry it back 2 years. All right. If you carry it back 2 years, you can absorb the income from those prior 2 years. And then if there's still NOL left over, it carries forward after that. Or you can decide just to waive the carry back and carry it forward from 2024 moving on. Whatever year that NOL lands in, you can only burn up 80% of the taxable income in that particular given year. Okay, let's talk a little bit about high income strategies. All right, we're going to run through this really quick. Prepaying expenses, income averaging, we might defer income, accelerate depreciation through 179 and bonus, and we'll also talk a little bit about crop insurance. So on prepays, we got 2 things to watch out for on prepays. We got there's a 12-month rule for benefits can't exceed 12 months, or it can't go beyond the following tax year. All right. So like if you had an insurance premium that you paid, 12 a 1 year insurance premium you paid in November, that's perfectly okay. Now, we're also limited to 50% of the Schedule F expenses. So when you get all said and done at the end of the year, look at your total expense for the Schedule F, chop that number in half. That's how much you're able to prepay. There are some mulligan rules if you're a farm-related taxpayer and you haven't gone over in the last 3 years. Now, the most important thing on prepays that I want to hit here is this slide right here. You have to actually buy something. Don't just go to the co-op and put money on account. All right. I've had people show up at the tax appointment and give me the co-op statement and it says money paid on account. In fact, they were getting paid interest. Okay, I can't count that as a prepay. Valid business purpose, you're fixing supply and you're fixing price and assuring yourself of supply. The non-material distortion of income, that's simply just don't do anything crazy compared to the previous year. If you once you start prepaying, typically you're going to keep prepaying. All right, on income averaging, looking at income averaging, you've got we do this on Schedule J, and this only works for farm income. Only works for farm income. It doesn't affect self-employment income. It doesn't affect taxable income. All we're doing is it's simply blending my rates. Now, let's look at this. This is a chart where it's going to show that this is a situation where income averaging would work very well for the producer. All right. This line right here is the top of the 12% bracket. All right. We had income in 21, 22, and 23 below the top of the 12% bracket. We got all kinds of money here in 2024. All right. What we can do with income averaging is we can take an equal amount of money and take it from 2024 and we could put it back into those prior years. So the key is it has to be the same amount of money each year. So if I decide to put $30,000 back, I got to put 10,000 in 23, 10,000 in 22, 10,000 in 21. This does not require filing an amended return. It does not require doing anything beyond just filling out the form when you file the tax return. All right. The IRS, by its own estimation, is saying this is an underutilized thing. By all means. So mark that one down to talk to your tax professional about that. Okay, deferred crop sales. The thing about this is this is where maybe you're under contract to sell something before the end of the year. All right, and you decide you want to defer it. All right, well, what you can do, folks, is first of all, under the constructive receipt rules, you can't just tell them to hold the check. All right, you can't do that. What you have to do, folks, is you have to what you have to do is you have to do a deferred payment contract that have a formal contract. Might be with the ethanol plant, might be with the co-op, and what you're able to do is set that thing up. And what I would recommend is doing multiple contracts for one big sale, because that way, if you find out when you file the return that, gee, we'd like to pull a few of these back into 2024, you can't bust up a contract, but if you've got multiple contracts, you might be able to pull one or two contracts in. So that's kind of the key point. Okay, we're gonna have to go really fast here. All right, depreciation for 179. That's 179 is where we could write off machinery, equipment, single-purpose ag structures. We can go up to 1.22 million on that. That's still in force, same as what it was last year. Bonus depreciation, we're at 60% bonus for 2024. Now, bonus is like a light switch. You either take it or you don't for each class life of property. I personally like Section 179 a whole lot better. Deferral of crop insurance. All right, what we have to do on deferral of crop insurance, and I know there's probably a ton of crop insurance out there this last year. First of all, in order to, and Ron, give me 2 minutes, I'll be done.
Yeah.
The on the crop insurance, you have to be cash basis, and you have to show that you would have normally sold that crop the following year. Now, this Nelson versus Commissioner was an Eighth Circuit court case. All right, we've got some different rules in Minnesota and North Dakota that you have to deal with. You have to look at each individual commodity. All right. So if you're growing corn, beans, and wheat, right, you need to be selling over half of the corn, half of the beans, and half of the wheat in the following year. If you fail any of the three, you can't defer. All right. I don't agree with that interpretation, but that's the way it is on that. Final thing that I want to look at here, just to kind of give you a heads up here, and you can kind of follow through on this chart. Okay, I did a put together a tax planning example where we had a Schedule F of $200,000 taxable income of 126, had a total tax bill of $44,000. So this 126,000 is going to be kind of up here in the middle of the big green hump. All right, and what this taxpayer's goal was to get down here to the top of the 12% bracket. So what we ended up doing was we ended up doing a combination of prepayments and Section 179 to take an additional $42,000 worth of expense, and I got the taxable income down to 94,000. Tax bill was going to be 33,155. So we went on the chart from here down to here. All right. Now, bottom line on this whole thing is we spent $42,000. We cut the tax bill by close to 11. And what we did is we moved ourselves down into that lower bracket. All right. Now, what's goofing us up and not giving us a dollar for dollar going from the top bracket to the bottom bracket is that doggone qualified business income stuff. With that, Ron, I guess I can kind of go online. I can go into the chat and kind of answer questions, or you want me to take them now?
Okay, yeah, there's three questions here, but we better move on. You
Okay.
could answer them on the well, there's two in the Q&A box and one in the chat box.
Gotcha.
And
Okay.
and you could just type in those and then everybody could see those.
Can do.
Yep. And we need to keep moving on then. So if you would unshare and then we'll get JC lined up here. Well, we've got a new speaker this year. His name is JC Hobbs. He's from the Oklahoma State University. He's an extension specialist and his title is Extension Specialist for Ag Tax and Farm Management. He's been there since 1985. He provides leadership on the Oklahoma State University Farm and Business Tax Institute, and he's based out of Enid, Oklahoma, and he also helps with the IRS in coming up with the publication 225. He's on that IRS committee. So it's good to have him here, and I'm glad that we got to have him. So with that, Jay, if you're ready to go, we will just keep moving on.
As Ron said, with Oklahoma State University, and this presentation comes from pretty much the same types of or sources that Rob Holcombs does. The National Income Tax Workbook, which we're parts of, both of us are. There's 23 states that are involved in that. Also the Rural Tax Group, and plus some of this coming from the Farmer's Tax Guide work. Given what Alan's has covered in the energy credits, and his material is much more in depth than I have, what I thought we would do is we'll go through the wind turbines and solar farm leasing issues, oil and gas reporting, and then hit a little more detail of the depreciation that Rob started with. So those are going to be the key ingredients of the things we'll talk about. So with wind turbines, these are getting much more popular, more expansion, and depending upon where you're at, most of the payments I'm finding, it's an annual payment per tower, and they're typically looking at a 30+ year lease. In Oklahoma, we're running around a 35 to 40-year lease on those. So it makes it like a long-term lease payment. Also on those wind towers, there could be a royalty payment based on a kilowatt hour of electricity generated. And in some scenarios, and depending upon what state you're in and what kind of negotiations that have taken place, it can be an annual payment with a royalty payment over the top of that. And sometimes these royalty payments are based upon two levels. Royalty, or depending upon what level of electricity is generated. Once we reach that point and then we go to the next tier, we often will receive a higher amount of payment. So again, be an annual payment, royalty payment, or some combination of the two. Now, this payment is ordinary income, so it's taxed on the Schedule E of the Form 1040. It is not farm income or business income to the landowner, basically, so that payment is not going to be subject to self-employment tax. So just simply ordinary income tax on Schedule E of the Form 1040. Now, solar panel farms, and I had a couple of companies actually come to the family farm and trying to negotiate with us on these, how we would set up, or would we be willing to, first off, sell them a parcel. They were asking for 40 acres in the initial request. They came back to us and asked us if we would take a rental arrangement on that for a term of 20 years. And so if you look at these things, most of what I'm finding out is an annual rent payment, and it's based upon the number of acres that get covered by these panels. The terms on some of these are 15 to about 25 years. Most common runs that 20 to 25 year lease term. That's the most common. Now, these rental payments, just like they are with the wind turbines, it's ordinary income reported on the Schedule E of the Form 1040. Also, remember, like on the others, it's not subject to self-employment tax. Now, there is one thing here at the bottom. It talks about property tax issues. Now, I know this is in North Carolina. I actually have proof of what happened. So, solar panels were put onto the farmland. That farmland was no longer ag use designated. It became commercial use designated. And for taxation purposes, the cost of that went up drastically. Oklahoma, we're still testing the waters on this. I do not know what will happen in North Dakota, but more than likely it will cause some shift from ag to commercial use. The question becomes, who pays the tax? In North Carolina, the companies actually negotiated with the landowners and were compensated for the additional tax that would be paid since it was now converted to commercial designation. Oklahoma, we're still testing the water on this. The last contract I saw actually was some compensation to the farmer or the landowner for the loss of that ag valuation. So something to look at. So when you see these leases and coming into play there, be sure to find out what will happen on that conversion. It can drastically change the amount of property tax due. Then we'll get into oil and natural gas. Now, we're looking at the royalty payments and the income being generated. Here in a moment, we're going to talk about some other payments that show up for easements, etc. But right now, we're just looking at what is being generated for electricity, or in this case, now we're going to get oil and natural gas, how much they get paid for the production of barrels of oil or 1,000 cubic feet of natural gas from these wells. Now, we're assuming that this is a royalty owner, so the mineral owner. They're not participating in the well. They're simply receiving a payment for the amount of oil or gas, or both, being produced and sold. So the payment that they receive is ordinary income. They receive that on a 1099 miscellaneous from the company, and then it shows up on Schedule E for the farmer, or the mineral owner, rather, the mineral owner. So these oil and natural gas, it, again, since they're not in the business of producing this, it's a royalty payment. It again is not subject to self-employment tax. Now in Oklahoma, and I don't know about other states, but I know some farmers or mineral owners in Oklahoma that actually, instead of getting a royalty payment, they worked or talked to the oil and gas company, the producer, and instead of getting a 1/8 or 1/6 or a 3/16 royalty payment, they would be willing to invest in the well. they're going to pay the production costs or their portion of the production costs. Typically, they're investing for 25% of the income generated, so they're paying 25% of the expenses of producing that well. So not common, but it does occur. If they are involved in the well production, they are now in the business of producing oil and gas. They are now considered a working interest. That amount that they receive would be subject to self-employment tax, and that payment would be reported on the Schedule C of the 1040 as business income. Now, one thing to keep in mind, this is a wasting asset. In other words, as we pull it out of the ground, the oil and the gas, it depletes the amount of oil or gas in those reserves. And depending upon what the geologists and a few others say, it is a depletable deduction that is allowed. Federally, that's about 15%. It could also be a cost depletion, which is calculated based upon a few other pieces of information. Didn't really get into the cost depletion versus percentage depletion, but you're allowed to take the larger of those two numbers. So when you work through that, you do the calculations. In our national income tax workbook for this year, and Rob's got a copy of that, I do too, we actually have some examples of how cost depletion is calculated for oil and gas, and compare that then to the percentage depletion, which is allowed by the Internal Revenue Service, which is 15%. And again, you take the larger of the two as the amount of deduction allowed. Now, those are all separate pieces. So for solar, wind, oil and gas, those two prior discussions, got to think about them separately. Now we get into things that will impact both or all of that. Those are called easements, damages, things like this. Now, easements are what allows the company to come onto the property, utilize that property for drilling purposes or for transmission line purposes or setting up solar panels or wind turbines. It could be pipelines, power lines, all kinds of different things. So these easements can be permanent, especially if you're looking at a pipeline easement. A lot of times there's a 50-foot permanent easement along that distance of that pipeline to allow the company to come in, do work, clean up. If there's repairs that need to be made, they can come onto the property. They have a permanent right to access that property for as long as that pipeline is there. So a permanent easement is separate from a temporary or working easement. When we lay a pipeline or we put up a transmission line for electricity, and on the farm that I operate, a wind turbine company wanted to put a power line in. The permanent easement where they have the power line laying and set up is a 25 feet wide for the length of the farm. But the working easement that they used while they were putting up the power line, while they were constructing the line, setting the poles, running the trucks through, etc., was actually another 50 feet. So I had 75 feet total easement, 25 feet of permanent that's going to last there as long as those lines exist, 50 feet of temporary easement. That reverted back to me as soon as they got the lines laid. The tax treatment of those is a little different, and we'll talk about those in just a moment. So then we have damage payments. When they went across the farm, there was crop damage. I was paid for that. Crop damage is basically a loss of the crop due to the trucks running over it, etc. And those damage payments will show up on the Schedule F as basically crop sale because they're replacing some of that loss of the crop. There was also some possibility of land damage, contamination, soil compaction, etc. Those trucks are heavy, and depending upon where you're at, in Oklahoma, soil compaction is really not much of a problem. But with the oil and gas exploration that's taken place, we have saltwater spills, we have other things, and contamination can occur. It's The current rules state that the company, if that happens, have to do a reclamation program. But some of these land damage, and reasonably so, they may not be able to get all of the contamination up. So the production on that parcel is severely reduced for a period of time until the contamination kind of resolves itself. So land damages, those are basically tax treated a little differently. The damage is reduction in the value of that property. It reduces the basis in that land. So let's talk about these in a little more detail. So here we have a drilling pad and tank battery that's put on the farm. Both of those are long-term. They're going to be there for so many years. Typically, those are for a 30-plus year lease term. They expect those drilling pads or the well itself and the tank battery to be there for quite some time. So a 30-year lease term is treated as a sale of an interest in that property. So it's not ordinary income. It gets capital gain treatment and is reported on Form 4797 as a sale of business property. The holding period dictates whether that's long-term or short-term capital gain. Another way that could happen is, since it's a long-term lease, 30 plus years long, you reduce the basis in that affected land. That lease pad may affect 5-10 acres, maybe less, depending upon what the company has done. But you look at the basis in that parcel at 5 acres and compare it to the basis in the entire property, depending upon how much you're paid. Let's say that 5 acres, they pay you $20,000 and your basis in that 5 acres was, say, $3,000. You reduce your basis in that to zero and you pay tax on the remaining amount to $10,000. So reduce the basis, you only pay capital gains tax on the 7. So it gives you a little bit of relief there of what's going on. That's for the long-term lease. Short-term, if your holding period is less than a year or 1 year or less, then it's short-term capital gain, no treatment where you adjust basis. Now, like I said, that pipeline easement on the farm that I was dealing with, we had a 50-foot permanent easement. That's where they went through and laid the line. They have access from now on. The temporary working portion where they piled the dirt when they dug the trench, where they had the machines running through for a shorter period of time, that's the working portion. The permanent easement, that's the payment that you get for that long-term portion. Again, sale of that interest in the property. Again, you can reduce the basis in that portion down to zero and pay the tax on the difference. Or if you don't receive as much as your basis in the property, you reduce the basis, and it's not a taxable situation. You get the relief there. The working easement, that's payment, treated as a rental payment. Again, if you look at what we've talked about prior to rental payments, it's reported on Schedule E, subject to self-employment tax. It is ordinary income, not subject to self-employment, but it is ordinary income reported on Schedule E. So what's the permanent easement portions? That's the drilling pad, that's the tank battery. Pipeline for oil and gas transmission, electric transmission lines, the access roads. And again, tax treatment depends upon the holding period. So here's the holding period rules. If the land has been held more than 1 year, so more than a year, that payment reduces the adjusted tax basis, but it cannot reduce that adjusted tax basis to below zero. So if it reduces it to zero, the remaining amount is given long-term capital gain treatment. And depending upon how much your income is, it could be 0, 10, up to 20%. Usually don't see it to 20s, but it can happen. So again, if you're looking at it, when you consider what we talked about in the prior discussion, where the ordinary income tax rate, capital gain rates are much more of a benefit. If the land has been held 1 year or less, so 365 days or less, that entire payment is given short-term capital gain treatment. So it's not subject to self-employment tax, just like the other. However, it is subject to the ordinary income tax bracket rates, which are, again, starting at that 10, going up to the 32s. And consequently, if we can avoid on short term, we'd prefer to have it treated as long-term capital gain. So the working easement, like I said, is treated as rent payment. That's that construction area. So we're looking at these wind turbines. A lot of times that working easement, they'll pay for a whole farm in some situations for them to work on, run around on, etc. But typically the working easements, construction of a pipeline, construction of a transmission line, is going to be for a short amount of time. They're usually going to be in and out within the year. They're done. And again, ordinary income, Schedule E, not subject to self-employment tax. Trying to drive that home. Now the permanent easement, depending upon what's happening, and with these wind turbines, it can sometimes affect the entire property. With a pipeline, electricity, transmission lines, it may affect less than the entire property, considerably less. So with wind turbines, the contracts in Oklahoma will basically specify that the landowner cannot build any structures on the property that would impair wind flow. So no barns, no houses, no orchards, etc. In that case, even though the wind turbines may only be on 80 acres of the property or even 40 acres, if the farm is 160, it's affecting the whole thing. Therefore, when we look at that, the basis adjustment that would occur on a wind turbine project may look at all the acres in the farm. Consequently, when you look at some of those scenarios, often results in less than the total basis being, or less than the basis being reduced to zero. It will still have some remaining basis. Consequently, the payments made for that permanent easement on these wind turbine projects is not going to be subject to tax. We just simply reduce the basis in the property. So it has major impacts, and you've got to look at both parts when we start dealing with easements. You've got to look at the permanent side, the working side, and then you have to look at the basis from the property that's affected versus the property that's not affected. So if we're looking at, and I put in a couple of examples here to kind of drive this home a little clearer. Here's we have an allocation to the affected property. So the easement, basically in this scenario, let's call it a pipeline easement. That easement affects 20 acres of a 460 acre parcel. The basis in that land is $100 per acre. If the landowner is paid $6,000 for the easement, so the payment is $6,000, the basis is $100 times 20, $2,000. The taxable gain that applies is $4,000. Now you're probably laughing at this number, basis of $100 per acre. This is actually a parcel that my mother owns, and this is an honest to God example of what happened. And so when we played with this thing, we reduced our basis in that, and we had a taxable gain that did occur. Now, if the easement affects the entire property, these wind turbines do that. So in this example, we got a 160 acre parcel where the farmer is not allowed, the landowner is not allowed to put up any obstructions to wind flow, so it affects the whole farm. If the entire farm is worth the $50,000 basis in that is then adjusted for the sale of the easement, and depending upon how much that is, will dictate whether or not we have taxable gain or if we simply reduce the basis down to a level and no more tax, not taxed at all. So the basis, depending upon, let's say they were paid $40,000 to put up the wind turbine project, it affected the whole property. So we have the entire basis of 50,000. So allowed to offset that payment of 40,000. Now the basis in that 160 went from 50 down to 10, and we have no taxable gain that would show up on the tax return. So we're simply using Form 4797 to show the adjustment in the basis, and we'll have to keep that information for as long as we own that property, because we do sell it at a later time. That will be our new basis that we use to dictate how much tax we pay on the sale of that parcel. Now, these damage payments, we talked a little bit about those. Let's go into a little more detail. Crop damage, when they go through the farm, a lot of times what happens is we get that sale of crop, or that damage is treated as a sale of the crop, reported on Schedule F. So when they went through the farm that I was working with, they destroyed about 30 acres of wheat. And the way it worked out, they just paid us for that 30 acres based upon what was normally, or what was harvested on the rest of the farm. So they averaged it. They gave us the average price for that crop on that we sold. And consequently, that was the amount of income that was reported on Schedule F as replacement of income. Soil compaction, land damage. When those occur, typically that's going to offset property basis. So land damage, reduction of productivity. Soil compaction, also reduction of productivity. We reduce the basis in that property by the amount that we're paid. So we don't have to pay tax on it. We simply reduce the basis. That won't be recognized until we later sell the property. Talk about tile damage. Depending upon where you're at in the country, sometimes when they lay these pipelines, it goes across the field and has tile in it. They'll hit the tile, break it, damage it. Typically, that information, or those are in the contract itself when they lay the pipeline. Any damage to structures such as the tile is to be repaired by the company as they start filling the hole back in. Therefore, there's not a taxable event because the farmer's not compensated. We just simply have the company replace the tile, repair the damage. It's done. Now, Ron hit these real hard. I'm going to go ahead and blow on past this a little bit because his coverage was much more in depth than what I have here. If you really want to look at it, it's pretty much the same information that he provided, maybe presented a little differently. But again, I don't want to rehash. It's time to get off that horse and get on to another one. So what we're going to look at is talking next about some of the depreciation rules that I was asked to discuss. Some of the changes that are coming about because we're looking at 24 and 25. There's going to be changes to the additional first-year depreciation, as Rob talked about, the bonus, the Section 179 expensing election, which was made permanent, and then we've got some makers changes that's coming about that took place as well. Let's go ahead and cover and talk about some tax planning, some things to think about, etc., concerning depreciation. So Rob made the statement. It's still with us. Bonus depreciation. Here are the numbers. It's allowed for new and used property, but it requires, when we look at applying this, it's applied to all the assets purchased and placed in service that year that fit within a certain class life. So when you're looking at machinery and equipment, it's a 7-year life, and we're going to use bonus on that, then we have to use it for all assets in that class. We can't pick and choose what asset but we can pick and choose what class life of assets we want to apply this to. 2024, the number is 60%. It drops to 40% in 2025. So if you're going to look at this thing as we get to 2026, it goes further. Sunsets after December 31st of 2026. So January 1 of 2027, unless Congress does something to change this, it will go away. Now, the question is, will it? We've had bonus depreciation for many years. It was set to disappear many times over that period of time. It started out in the 2000s. Made adjustments in 2010, 2017. It keeps coming back. Will it come back? Gut feeling is probably, but there's no guarantee that it will. So with bonus depreciation, it's assumed that when we file our tax return, that we're going to use bonus for depreciation for any assets placed in service. You have to elect out of bonus depreciation in order not to use it, or you can elect out on certain classes of assets. So with bonus, it's assumed to be used unless you elect out. One of the neat things about bonus, it can create a farm loss. So we can use more depreciation there than we have farm income. It offsets W-2 wages. It can offset that oil and gas income from royalties. It can offset that wind energy income from turbines. So it can impact other sources of income than just the farm. But remember, it can create a farm loss. Conversion of an asset to personal use does not require the recapture of excess bonus depreciation taken over regular maker's depreciation. So what does this mean? We decided to buy a pickup a few years ago. We bought this pickup and it's 100% business use. We look at it this year, it's getting a little old. We decide, well, we're not going to use it on the farm anymore. We're going to use it for personal use purposes only. So it's no longer a farm asset, but even though we used and took depreciation as a farm vehicle, we do not have to recapture that. We're still allowed to just carry it on the books at whatever level it was when it was truly a farm vehicle. So we don't have to make any adjustments. It gives us the opportunity to carry that forward. Now, the 179 expensing election. It was made permanent many years ago, and it is indexed for inflation annually. So the 2024 numbers, it's $1,220,000 of assets placed in service that we can use 179 expensing on. But if we buy more than $3,050,000 of assets, we reduce that 1.22 million down to zero for every dollar above that. So it gets reduced if we put a lot of machinery and equipment into place. In 2025, like I said, it's adjusted for inflation. It goes up another 30,000, so it's 1.25 million. The investment limit also gets adjusted for inflation, 3.13 million. Now with bonus depreciation, we allowed to create a loss. But with Section 179, we are not. It cannot create a farm loss. It can, however, reduce W-2 wages, but anything that's not used in that year is carried forward to the future year. So any unused amount that we cannot reduce farm loss or farm income below, we don't lose it, we just move it forward. We kick the can down the road. So it's very unique, gives us an opportunity, again, carry it forward, don't lose it, but you have to be careful. If next year we don't have much farm income, we have a lot of carryover 179, we may not get it all used up in 2025. May carry it to 2026. Right now, it doesn't expire, so it will be used up at some point in time. It just may take a few years to get there. Now with 179, a little different than bonus. Bonus you have to elect out of, elect not to use it. Section 179 requires an election to use it, but we have the ability to elect to use it on a specific asset or a group of assets. Now remember when we had bonus, it was a class life grouping. Here it is, you can group any asset you want to, or just use one specific item. So you can pick and choose. Again, great for tax planning, tax management, because, like I said, you pick and choose how much you want to take. Can't offset W-2 wages. And that one thing that does occur with 179 that didn't occur with bonus, if we take that same pickup that we used in that prior discussion and we take it from a farm use to personal use, we do have the requirement to have recapture of the amount of depreciation that the 179 allowed us to take that is would be in excess of the amount of regular maker's depreciation that would have been allowed. So conversion to personal use requires a recapture of depreciation taken. In addition, remember I said you could use it on a specific asset. You can also use it on a percent of the asset's cost. So you buy a tractor for $100,000 and you decide you don't want to use but $50,000 of 179 against that tractor. You can use 50,179 and you can retake the remaining 50,000 and use regular maker's depreciation. So again, a little different tactic to or adjusting your income tax planning, but it does again allow you to work from that. Now, cost recovery periods. Some of these have changed over the years. Just a reminder, I still have tax preparers that come to me, well, I forgot. I didn't know. Cost recovery periods did change. Coming back to the Tax Cuts and Jobs Act, when we were trying to stimulate business growth and a few other things, we brought in again the bonus, made Section 179 permanent. We decided then new machinery and equipment, farm equipment, was allowed to be 5-year assets. If it's used, it's still 7 years. So by manipulating or by trying to, again, get business stimulation in place, cost recovery for farm machinery was allowed to be modified, taken over a longer period. Machinery equipment, grain bins, fences, cotton ginning, they're still required to be 7-year recovery property. They're not machinery equipment. So that didn't change for them. So again, new machinery and equipment, 5 years, used 7 years. Something else that was brought into play, it used to be required, and this started back in 1986, and farmers were required to use 150% declining balance on all depreciation for farm assets. Then with the Tax Cuts and Jobs Act, it was decided that we would allow farmers and ranchers to use the double declining, the 200% declining balance, to be allowed against 3, 5, 7, and 10-year property. So all farm assets, other than multi-purpose farm buildings, drainage facilities, water wells, land improvements, are then allowed to be 200% declining balance on those pieces. Anything, those water wells, other multi-purpose structures, it's still 150% declining balance because those are 15 and 20-year recovery periods. So 200%, 3, 5, 7, and 10 years, 150% on 15 and 20. Now, Ron, I think I'm pretty well on time for your questions. So if you have questions concerning some of this, like I said, you kind of got robbed a little bit on the energy credits, but Alan covered those very well. So I'm not going to rehash that. If you have questions after the webinar is over and you want to discuss this further, you can send them to Ron or you can send them to myself. My information is at the very bottom. Make sure that we get those answered as we go. So with that, Ron, thank you for allowing me the opportunity to be here. I do believe I finished on time.
Yeah, and we have a question for you too now. In the question and answer box, for the $3,050,000 Section 179 limit on purchases, is that just the boot price paid or the gross purchase price of those assets?
That's the gross purchase price of those assets, all of them.
Okay.
So if you invest that many dollars in all the assets, then you've hit that investment limit.
Okay. I want to introduce you. This is Russ Tweeten. He's Vice President of Agribusiness Consulting. He helps families work through complex issues in estate planning. He was raised in Fargo. He has a BS degree in Ag Econ from North Dakota State University. He's a certified trust and financial advisor. And he's been in the financial services business for almost 25 years. So, and we've had him as a speaker quite a few years now. He's always had some good information for us. It's information that will affect us all at some point. So with that, I'll take it over to you, Russ.
Yeah, well, thank you. Good afternoon, everybody. It's always a pleasure to speak to this group. We're going to come at you with a little different approach this year. Okay, yeah, a little different approach this year. I've been involved with a kind of a national organization to examine the possibility of putting the work that my team does into 12 other states, mostly central and western United States. So I'm going to share some of the data that they've put together, but some of the things we're learning as we get into what the future looks like is on this first slide, stating that, you know, if you're not planning for the future, your neighbors probably are. And this is just a message that we're starting to really use with our customers, is really becoming a long game. The planning process is not short term. It can't be anymore. As these farms get larger, land values go up, machinery lines get bigger, consolidation continues. The long game is becoming the game, and will really start to become a big part of what farms should be looking at doing as we move forward. So here's what we're going to go over today. I'm going to talk about what we're seeing, what my team is seeing, and some of these research studies that Ernst & Young has done. We're going to talk about the importance of review. I know for those of you that were on the call last year, I went over this a lot. It's never been so important as it is now. Reviewing documents is going to become vital. We're going to go over estate planning, and Ron asked me to share the charitable remainder unit trusts and charitable remainder annuity trusts and where they might fit. We're going to talk about transition and retirement. Of course, my favorite topic is to talk a lot about communication and how we work with the families. So what we're seeing, this is no surprise to anybody, high land values. The problem's coming is with some buyouts. I've got a real case study coming up later on that'll show you what we're dealing with in a lot of situations. One thing for sure, wills and trusts are just not being reviewed enough, especially when there's a successor. If you've got somebody that's coming into your farm, it is really important to have that will or trust looked at every 3 to 5 years. If you don't, maybe every 5 to 7. We'll talk about that in a minute. Consolidation continues. Again, nothing new there, but the consolidation, the pace of consolidation seems to be picking up. It isn't a quarter or 2 or 3 that's moving to either the next generation or to neighbors. It's 4, 5, 6, 7 quarters, which can really change an organization, a farm, if they end up getting all of that. Labor and capital continue to be challenges. You know, who does the work and where does the money come from? I don't think I've talked to a growing farmer in the last few years where they don't have challenges with labor. So we're seeing a lot more H-2A and a lot more foreign workers coming in. So let's talk a little bit now about the EY study. And again, EY used to be called Ernst & Young. And what they showed was 61% of the farmers and ranchers do not have a documented or communicated plan for their transition, their estate plan or their retirement plan. And they showed the following reasons that they might get in and motivate themselves to get something done. And on the survey, it said they get in because they're aging. Number 2, they figure out that they really want to leave a legacy, or they might have gotten advice from someone, like maybe the group we're talking to today. But that's what gets them in. So who do they trust? And look at you folks, you're right at the top. They trust their accountant, they trust their lawyer, their tax professional. Again, as you work down through the list, a lot of times they'll find out about what they should be doing from seminars. Individuals who are encouraging them to take action, such as their clergy. I've had clergy members in meetings when we do family meetings, siblings and maybe a friend. The study also asked what benefits they're looking for with a succession and retirement and estate plan. The number one item was peace of mind, and I can certainly back that up because many times when we get done with a project, especially an estate plan, one of the things I'll often hear is we just feel better now about things. We're at peace, or we know what's going to happen. They want a thoughtful, long-term strategic plan, and here we are back to that long game. Really an important component of a strategic plan. They want long-term operational success. Success is the term is, that's all over the board. Some people it's financial success, some it's that peace of mind, others might be to ensure that that fourth or fifth or even that sixth generation now has the ability to take over. Again, this, they're all after tax efficiencies, but I think one of the things that scares the daylights out of a lot of farmers, other than the nursing home, which we'll talk about, is the estate tax. We're going to talk more about that later on. They want to preserve the long-term farm and the business, make sure that farm is financially viable. For sure, most want good family cohesion and alignment. They just don't want to see their children disagreeing. We'll talk about what we're seeing there here in a minute as well. Reduce the risk of the farm continuity plan. Continued access to somebody that does this work, whether it's you folks, whether it's us folks, if it's their loan officer, their lawyer, they want access to talk to somebody about it. Legacy preservation, and then access to somebody that they trust to maybe sometimes ask hard questions. Here's something else we're seeing. These are appraisal benchmarks that some of our research have shown, and these are the average increases with cropland in North Dakota. The 1 year is 9.2%. If we look at the increase over 2 years, 37.9, over 3, 78.8, over a 5-year period, it's 95%, and over a 10-year period, a 61% increase. The big change is coming in northeastern North Dakota. I can attest to that. We have a consultant up in the Grand Forks area, and she's constantly telling us about 5-figure land sales, $10,000, $12,000, $13,000 per acre. The average cropland value in North Dakota as July 1, 2024 was $65.88, and for pasture about $12.02. And again, that's an average, depending on what part of the state you're in, that's going to, of course, be a little high. It might be somewhat low. So what influences these land values? Well, right now it's good 2023 crop yields and also strong cattle prices. We'll see where things go now that 2024 is looking to be a little bit of a rougher year. 2025 is what our loan officer team is forecasting is looked to be perhaps an even tougher year. So we'll see to what extent a dwindling farm economy, if I can use that word, has on these land values. Strong cash reserves and good working capital positions bolstered the land market. A limited supply of land. I read an article a couple of weeks ago authored by an individual at Farmers National that said there's approximately 25% less land on the market year over year. And you kind of see that. It just doesn't seem like there's a lot of land sales going on right now. The ones that are being held are still showing extremely high land values. Stabilized interest rates. People like stable rates. If they see that the rates are starting to stabilize and maybe top off or stay where they're going to be, that helps them do a little better job budgeting and determining, is this something I should be looking at now? One thing that I hear a lot, and we're going to get into a case study here in a second on number 5, is I farmed the land for a certain period of time. I need to keep it. Cost becomes an issue, but losing it outweighs cost. And so you just, you don't want a big hole in your ground. Of course, weaker commodity prices may have an impact on this. The good news, though, most farm real estate is still being purchased by farmers and ranchers. There's a lot of concern with many farms and ranchers when an investor comes in, buys up land, and jumps up the rents. Usually that has a ripple effect with everybody else bringing their rents up. So this is what we're seeing in the land market. Here's some federal stats. The average, and this comes from USDA, the average age of a U.S. farmer now is about 58.1. Right now, there's approximately 880 million acres of farm and ranch land in the United States. Approximately 60% of that land is owned by someone aged 65 or older. 2% owned by someone aged 35 or younger. This is a big statistic, and I looked this at from several different angles, and the number that I kind of came up with was right here. And USDA has a report where I think this is exactly what they're using. It's estimated that over the next 15 to 20 years, 70% of U.S. farmland will either transfer ownership or change ownership. So there's a lot going on, and this is going to have an impact on what we see as planners. The stats can lead to the following. The wealth transfer to families sometimes happens without consideration that there's a farming and ranching family out here who need this land, and buyouts need to be financially viable. If there's one thing we're seeing starting to emerge and develop is this disconnect between those that farm and those that don't. I heard the analogy the other day, land ownership is kind of like a barbell. You've got the farmers and the landowners. And it would seem as the demographics start to shift and fewer people farm, we're going to see more land owned by those that don't farm. So that means we have to look at buyouts in these documents, which we're going to talk about in a minute on our review session, but a lot of them don't cash flow. The feuds between siblings and that farm and don't farm continue to rise. There's a disconnect a lot of times. But I also don't want to come across as being that this happens always. There are some very fun and positive success stories that we see where farming and non-farming children get along. They understand each other's position, and they find a way to get along. So there is financial stress out there. Unfortunately, we're starting to see just too many lawsuits. I work with one of our newer consultants is an attorney who worked locally at a local office and had taken a case to the Supreme Court. It took 9 years to get there and settle this thing. And now they're squabbling over guns. So this is real, folks, and we really need to have a plan in place. So this is a little bit of a busy slide. This is my case study. This is the most recent one. We have a 72-year-old farmer. His mother died recently. She was over 90. He had the ability to buy 200 acres of land from his sisters that his dad bought in the early 60s. So, over 60 years of 60 years of crop production. He knew he could buy it because of the comments they made to him, but he never did get a chance to see the will. That is very common with the 80 and 90-year-olds that we work with. The land was appraised at $8,900 an acre with about a $1.4 million value. Of course, sisters wanted to sell. He had $600,000 that he had in the bank, if you will. Really hesitant to get rid of that because he wanted to have a good cash reserve. So we ran some numbers for him at a 6.5% interest rate over 20 years of payments, $74,783. That equates to $374 per acre in an area where land rents are between $125 and $200. So when you look at this, 72 years of age, son can't afford to buy it. Son's tapped out. Land that's been farmed by the family for over 60 years, really hard to give up, fits in well with all their other land. So the $600,000 down payment will pretty much drain the savings account. So we are just suggesting try to look at that a little differently. He's 72. On a 20-year note, the land could very well pass to his farming son, because that's where he wants his land to go. Right now, there's no way that farming son could afford it. We work with him as well. If there was a sudden death of both our customer and his spouse near term, I'm not sure what we're going to do here other than look at the possibility of selling other land in order for Sun to take this one on. For sure, our 7-year-old retirement's lifestyle will probably change. Taking on that kind of debt changes what you can do in retirement. They rent additional land to their son. They're semi-retired, as mentioned, so they're thinking we may need to raise rents there if our family living starts to suffer. And these aren't people that are living high off the hog. These are conservative people who spend money wisely. At the last meeting, they were talking to me about the possibility of just letting it go. Let it go to the open market, and they'll go in there and see if they get lucky and are able to buy it at a price below that 8,900. So we don't know yet what they're going to do. They've got, I think, another 30 days to exercise the right and get that over to the sisters. But the point here, folks, is this is something we're seeing more and more. And when we get into the review section here in a little bit, we'll talk about some ideas for you. So here are some action steps that we've recommended people consider. Number one, know your numbers. I mean, know what your balance, what your will, your trust, even a buy-sell agreement for an entity. Know what those formulas result in given today's land values, and you got to use current values. You know, as you well know, most of the balance sheets that we look at, if they're prepared by a loan officer or even our customer, they're probably low. And you really can't work in that environment. You have to use the market values. When we do these for customers, the numbers almost every time when we take a will or a trust and run their balance sheet through that, it surprises them. And they've never really thought about it. It's never been an issue. But our goal here from a long-term perspective at Ag Country is to get this out there, get people talking about it, getting them knowing about it. We're certainly not here to say everybody needs to go out and reduce values. You just need to know where you're at, especially if you've got a farming successor. If you've got a business entity like an LLC, a corporate partnership, you know, every buy sell we do has a section that says the owners shall agree on an annual basis, and of course nobody does that, but there's a reason for that, and that's to know where you're at as well. We talked to a lot of customers about increasing discounts or a buyout duration in a will or a trust. Many wills or trusts, if land goes to non-farming children, the farmer has a right to purchase the land only if the non-farming sibling wants to sell. There's where the discounts can show up. The discounts range anywhere from as much as 10%. I've seen discounts go as high as 50% of the appraised value. We want to do the same for rents. I want to make sure there's something in a right of first refusal so a farmer can rent it. Of course, the easy way to solve this is to have life insurance purchased, usually on both parents. You know, it also can be used to equalize the estate. But my experience with farmers and buying life insurance is that's not what they want to do with their money. Now, we have several cases where we've done this and it does work. The life insurance is payable out to those that don't farm, and they usually don't get any land or a very small amount of land. And then we want to have a family meeting to talk about how farming son may buy out that sibling. This should not be a surprise. If both the parents die and all of a sudden the non-farming siblings discover that their brother who's farming can buy that land from them at 75% of the appraised value, that's not where you want them to find out about this. This should be found out in a family meeting. The family meeting also gives the children the ability to ask the why question. Why are you doing it this way? Okay. Some of the other ideas that we're suggesting people consider is maybe sell some land to the successor now rather than wait another 15, 20, 25 years. Of course, there's an immediate tax issue here. Depends on the cost basis. Often it's a contract for deed. So sometimes we just need to get into a basis discussion and see if it makes sense to sell higher basis land first. every case is different, but we have had several of our customers take this idea and get that buyout started now. There's another idea that's starting to emerge. I wouldn't say it's popular, but I'm seeing it used more than not. And that's the next item, and that's at the second passing of the parents. So both parents are now deceased. We might have the land stay in a trust for, say, a 5 to 10 year time frame, and then have the successor pay rent to that trust, with that rental income then going to the non-farming siblings for the term of the trust. This is, like I say, we've had several people use this idea, and then at the end of the term of the trust, the land goes to the farmer. So it's a way to kind of try to make that state distribution a little more fair. The third idea is to leave most of the non-farm related assets to the farmer, to non-farmers, and then the farm related assets go to the farmer. Again, when you look at a farmer's balance sheet, you all know 80, 90, 95% of that balance sheet is often farm related assets. It's rare to see a lot of retirement accounts. There's lake homes, there's Arizona homes, those can all be used. But sometimes that's not practical, especially if you've got a daughter that lives in Colorado and you've got $1 million lake home. Is she really going to want to get that lake home? So she could, but she'd probably sell it. So this is where the fair versus equal discussion often bubbles up. I mean, you just got to have that honest discussion with these folks. We can put land into an entity that allows the farmer to be in control of that entity. This works, but does it really take the problem away when you've got non-farming siblings who want to get bought out? I think it just shifts land to an entity, but the nice thing about the entity is it has a rule book. In other words, buy-sell provisions that state how the land is valued, how a buyout occurs based on the buyout value. So that's where land entities add value for jointly owned assets between farming and non-farming siblings. You've got some instructions that talk about how to take care of land sales. So wills and trusts should be reviewed every 3 to 5 years if there's a successor. No successor, every 5 to 7. And if you've got a buy-sell for an LLC, a partnership, a corporation, we should really be looking at that buy-sell agreement every 3 to 5 years. Things change, and they've changed drastically in agriculture over the last 10 years. All documents should have been reviewed or get into a review process soon. So our message is review your documents regularly. If you have buyout provisions in a will or a trust for a successor, or if you've got an entity, you should be reviewing as well and know what those numbers are. You should really know what those things mean, if they should be updated, or maybe they're just fine. So that's kind of what we're seeing, folks. It's getting to be the balance sheets are getting bigger, and with the consolidation in agriculture. Most of the land in the country owned by people that are 65 or older. For these farm balance sheets are probably going to continue to grow. So let's shift gears and get into grain inventory. I put this together just so you've got maybe a list. A lot of you probably already have something like this that you refer to. But how do we deal with grain inventory during transition and retirement? Well, obviously you can defer. Rob talked a lot about that with multiple contracts, making sure you fill those 22 and 24% brackets, especially 2 to 3 years ahead of retirement, maybe sooner. But I don't know about you folks, but a lot of times we don't get a 2 to 3 year time frame. We get a call in August that this is our last year. So that opportunity kind of misses itself. Then we have to get into deferring, obviously income averaging. I did have a couple of farmers do what the next section or the next piece, and that is to buy new machinery that they're retired and then lease it back to a successor. I'm not sure about this one. Just I guess financially it probably works, but is it really taking care of the problem? I'm not convinced it is. We do a lot of work with defined benefit pensions. especially where we've got no tax deductions left. Somebody's going to spend a lot of time in those 30% brackets. So we would put in a pension. Pensions aren't like IRAs and 401ks where the contribution levels are set by the government each October. You know, we get that circular. Defined benefit pension contributions are a function of interest rates, age, their income, and their gender. It's really a life expectancy thing that actuaries use. Pension contributions can get big fast. We've seen them go, when interest rates were lower, you saw a lot of contributions in that 400,000 plus. What we're seeing now is in the 250 to 300 maximum contribution for somebody that's in their late 60s with good income. Those are great deductions, but you always have to have the conversation with your customer about where are these tax rates going in the future? Are really just kicking the can down the road, putting you in a bracket later on in life where you have zero tax control. So then maybe we just go to the last bullet point there, just pay the tax and be done with it. You know, we are in a relatively low tax environment right now. We could certainly put a charitable remainder unit trust or charitable remainder annuity trust. Usually we'll see those with machinery. I'm going to talk more about that in a second. But we may not have a choice. We may need to pay down debt. And so we might not have a choice about paying the tax. You might just have to do it. So this is my laundry list of things I look at, and again, very case specific, to know which tool do I pull out of my toolbox to help our customer. So transition tools for machinery, bins, buildings, and infrastructure. Obviously, we can sell it. That's a big tax hit, of course, to our customer. The nice thing about that is the successor can now depreciate it. Lease new assets. A lot of people do this. If there's a shop that's going to go up, new bin site, maybe an extra planter. Think about having the existing, the senior farmer and the successor on the lease, have that successor make the final buyout. Operating leases, this is used to combat the installment sale tax. A lot of people want to sell their machinery to their son or daughter who's farming, but the son or daughter can't buy it all at once. So they want to set up a payment plan over time. Well, of course, this is when the installment sale tax rules hit us. And so the workaround here is to have an operating lease. We do these on both machinery and buildings and bin sites. The tricky part is incorporating trade language into that lease agreement. We want to make sure we give them all the options available. A lot of times the piece that's going to be traded off is just gifted to the successor. They trade it off and pay the boot. It can be sold, of course, or we can do the pro rata. I'm not sure this is my most favorite way of doing things because it makes record keeping complicated. But under pro rata, if a piece of equipment is going to be purchased for, say, 200,000 and the implement dealer is going to give you 50 on trade, you could use that 50,000 to keep that on the lessor's balance sheet with the 150 going on the lessees or the successors. Complicated, but it works. Again, we want to make sure we're bringing you folks into the discussion on these operating leases and just have your spin given to these successors. Piece by piece, that's a very common way to get machinery transferred. It's done incrementally over time. Usually this is done early on in the succession plan when a younger farmer is just starting to join the operation. They'll start incrementally buying pieces over time. Gift and increased cash rent. Don't see this very much, but we still see it where machinery line is gifted and the way it's paid for is by increasing the cash rent. So it's an indirect way of getting around those installment sales. Of course, we don't want anything on that lease agreement that would suggest it's an installment sale. Land, transitioning land, usually it's the last asset to transfer, if at all. Usually it doesn't. Yeah, the step up rules become paramount here. People really don't want a tax bill. What we have to look at, what we're going for, and it's one of the questions on our intake questionnaire before we even meet with somebody, is how much land do you own versus how much do you rent? If there's a lot of rented land, we know that the risk level for a successor to have to buy land is high. So that translates into what are we going to do in the parents' estate plan? Are they going to have to buy land out of that too? knowing that there's a high probability they're going to have to buy the rented land. So is protection a priority for your land? What are we protecting from? Is it nursing home? Is there an unstable marriage, an unstable child? Depending on the case, we have to design around that. How's land going to be transitioned? Will it be transitioned at all? Or will it just go through the parent's estate, which is how most of the time we see land moved, other than maybe that key piece, that home parcel, the farm site. A lot of times that's handled separately. And those 5 items are, I would just have you look this over. Every case is, as you well know, is very specific, and each application for one of those tools is based on their fact pattern. So what if we're retirement planning? We don't have a successor. Now we're getting out with probably more problems than we had when we started farming. Of course, there's financial, tax, and emotional challenges as you wind down. And I still see these independent, clear thinking, smart people get very emotional in some of our meetings when they're looking at being done. It can really hit them hard. Everybody's got a little different approach on this, which is why we want to tell people to give them some time. When we don't have a successor, we have to look at debt. Debt will stop just about every retirement plan unless our farmer is willing to sell assets to get that paid down. We need to know their time frame. They're always asking us when to start Social Security. I'm sure they ask that same question of you. My experience for most of our customers is when they hit full retirement age, which for the bulk of them is 66 and a half, 67, somewhere around there. And then how do you plan to pay for health insurance? So there's a lot that goes into this. We want a 3 to 5 year time frame. We don't always get it, but it's best for them. So for transition and retirement planning with a successor, here time is your friend. If you're the customer, if you're the farmer or rancher, we can do it quick, and we have. But if you've got time, 5 to 10 years is what we want, so we can maybe we need to get an operating lease in place. Maybe we need to do something with the building and the bin site that might take several years to move. What's the plan for the residents? Okay, who's going to live at the farm? Should somebody live at the farm? Okay, what about your son's wife? Does she want to live at the farm? Sometimes that's not always a popular choice. So this is why it takes 5 to 10 years, because there's a lot of conversations that need to be had that are difficult. That might be somewhat emotional, somewhat factual, but we've got to have those conversations. And the next bullet point, shifting power can be more difficult than shifting asset ownership. You've got some of these folks out there who have really done a heck of a job building that farm. They've controlled it. They've made all these great decisions. And now along comes this son of mine, this daughter of mine, who's going to start being the boss. And again, that is a timing thing. Some people are fine. They're ready to go. They're 67. They're getting out of the way and they're done. But that is certainly not always the case. And of course, the key to any good succession and retirement planning is good communication. We're going to talk about that a little bit more as we move through the slides. Nursing home protection. I think if there's anything that scares the daylights out of any farm producer, and that is having to sell their land because of a nursing home. So the way we usually hear it here in our shop is we lost our land to the nursing home. And again, I'm sure you've heard the same. And of course, the nursing home cannot make you sell anything. What ends up happening is if you have no or little nursing home insurance, there's not enough income or existing assets to pay for care. They've got to apply for medical assistance. There's no other way to get it done. Now you're going to be functioning under Medicaid and Department of Human Services rules. And those are tough rules. The quick and dirty here is if you're married, you can keep your personal residence and about $158,000 of other assets, a little bit of life insurance, cash value, prepaid burial. Otherwise, all assets have to be spent down, and that's when assets start to be lost, is when they're having to sell assets to pay for care. So the planning options that we go to, it's almost always going to be land. We can transfer land to a son or daughter or both, reserve what's called a life estate. The children now own the land, but since the parents reserved the life estate, they're entitled to cash rent income for the remainder of their lives. Okay? The caution here is what level of rent are you going to pay? Reduced rents are considered gifts and could disqualify a family member from receiving medical assistance. So what we try to impress upon our folks that do life estates is you should really be charging a market rate of rent. And more often than not, we're discovering they're not. We advise them you probably should. Market rent is, pick a county, it's going to be different. I should have put it in here, but the database that we use a lot is the North Dakota Department of Trust Land Survey. If you just Google North Dakota Trust Land Survey, there's a section in there, it'll pop up. But what Trust Lands does is it surveys producers every January to determine what kind of rent to charge for land that's owned by the state. It's a pretty good publication. In fact, I think that even might be what DHS uses. I don't know that for a fact, but it seems to me that's what I've heard. So we're doing this life estate. What are we looking at? Number one, we want to know is the children's marriage stable? Okay. Are they financially stable? Number three, are they emotionally stable? If we get a no to any one of these threes, we don't recommend a life estate. Well, we just don't go there. What we do instead is we might move to an income-only irrevocable trust, type of trust that you cannot change. Parents give up ownership of land, transfer the land into the irrevocable trust. The irrevocable trust is written in a way that states the parents would be the income recipients, but they no longer have any control over the land. It's questionable. Different practitioners will say parents can be the trustees. I'm not comfortable with that. That's just me. But if we're going to have trustees, it's okay, I guess, if they're family members. That it's really going to be here again case specific, but we're not big fans of having just the parents as trustees. There's ascertainable standards that can be worked into the trust, which limit what the distributions can be used for, but that's really going to be more on an asset sale. So here's some of the catches with an irrevocable trust. They can't be changed. Okay. Now they can, but it's going to take the signature of every beneficiary in that trust, including potential beneficiaries, which means your adult grandchildren might have to sign off on busting that trust. So we always want to make sure that people understand this is irrevocable. You cannot change it. If the trust-owned land is subject to a mortgage, it doesn't protect anymore. Again, this happens enough, where we put land into an irrevocable trust, and then I find out from their loan officer 4 years later that he's got a loan against land on that trust. It's not protected anymore. The trust has to file its own tax return. Land can be sold by an irrevocable trust, but the sale proceeds need to stay in the trust. And maybe that's okay. And of course, the land is stepped up at death as long as there's an income right to the parents under 2036A and 2036B of the code. Not only irrevocable trust land stepped up, life estate land is stepped up as well. So let's talk about state estate taxes. I know a lot of you folks are on the border here. You know about Minnesota. Minnesota is a decoupled state. They do not have their own, they do have their own estate tax. North Dakota, South Dakota, and Wisconsin do not. This just gives you an idea what that Minnesota state estate tax looks like. The exemption is $3 million per person, and if you've got the right will or trust, you get a $6 million exemption. If you have qualified farmland and a qualified heir farming the land, that exemption goes from 3 to 5. Or if you have qualified small business entities, so maybe you got a corporation that does all the farming, and that's farmed by a qualified heir, that allows the exemption to go to 5 million. So this is becoming a problem in Minnesota, folks. You get southeast of Fargo, you get south of Fergus Falls in that Morris area. I mean, it's not unusual for land to be at 10, 12, 13,000 an acre. So it doesn't take long to hit these numbers. There's no portability in Minnesota, as you know, at the federal level. You can port your unused exemption to the surviving spouse. You can't do that in Minnesota. We do need to have the right kind of trust in place. Now I'm just going to move to the last bullet point. Real estate owned by non-Minnesota residents may be exempt from federal estate tax, but it still can get drug into the Minnesota estate tax system. So what they're going to do is make you calculate the percentage of Minnesota assets on the individual's balance sheet, and they're going to make you pay a certain percentage as though they were a Minnesota resident. So it's not the whole thing that's subject to the estate tax. It's just the value of the Minnesota property. Tax Cuts and Job Act, Rob touched on this a little bit. There was definitely a collective woo on November 5th for most people in the ag community. There was a lot of, I would say, outright fear about where this exemption could have gone. So we now have the possibility of the Tax Cuts and Job Act either being extended. Maybe Trump will try to get a lot of that into permanent law. So what we've always tried to do, and what we think is smart, is to always design flexibility into your estate and transition plan. Because it's a state tax is a very political tax. I mean, it just always bubbles up somewhere during an election and kind of gets misused, if you will. So the current exemption, 13,610, 27,2 for a married couple. This is going to increase on 1/1 of 25 to 13,990, or 27,980 for a married couple. The annual gift exclusion rises from 18,000 per year to 19,000 per year. Like Rob said, none of us are going to want to guess on the probability TCJA is staying in place. The odds are better now, but you got to remember the majority, the Republican majority in the House is still pretty thin. I mean, who knows? I mean, it's Congress. It could go anywhere. We still think larger states should be taking a proactive approach to estate planning. Put things in place that allow you to get discounting, to move assets quickly, to do things that might need to be done when everybody else is trying to get the same thing done. Our fear in our shop is we were going to get killed the end of next year. Had the Tax Cuts and Job Act been sunsetted, I mean, there just weren't going to be enough planners in the area to take care of everybody's needs. So now we've got, hopefully, we'll see, 4 extra years to do some more advanced planning. So, we just don't think reacting to the government is ever a good plan. The estate plan, again, I'm going to move it on a little quicker. I only got a couple of minutes left here. We want to know, do we have a business we're going to transfer, or a business, a successor or no successor? Those wills are very different. The hard questions to ask sometimes is what are the parents' priority keeping the farm together? What do you want to have done? Okay. Rights of refusal should be placed on land that go to non-farming kids. Rights of refusal don't require anything other than a non-farmer to talk to their farming sibling if they want to sell land. It doesn't force anything to be done. Disability planning, for sure, everybody should have a durable power of attorney. If you've got an older power of attorney, which would be maybe 5 to 7 years or more old, you maybe want to look at having it revised, because the newer powers of attorney are including a clause that apply to digital assets. And of course, everybody needs a healthcare directive. For the nursing home, we need to have a conversation about how you're going to pay for that. That's part of the estate plan. We insure, we self-pay, or we get into the life estates and the protection strategies. The charitable trusts, again, we don't see a lot of these in agriculture. I probably work on 2 or 3 of them a year. That doesn't mean they're not good ideas. But the charitable remainder trust, the plan here is the advantage to the charitable trust, of course, and usually it's with machinery, as it's sold tax-free. If you sell machinery through the auction sale and pay taxes, you just don't have as much money left to invest. Well, a charitable remainder trust sort of solves that problem. It gives you a higher amount of investable income, and typically speaking, a higher amount of rental income or whatever the investment income is going to be spinning out of that charitable trust. That when I set them up, that's a lot of what goes into the decision-making process for a customer, is the fact that they found a way to increase retirement income. I'll let you look over some of the basic charitable remainder trust rules. There's two different types of CRTs we use. The charitable remainder annuity trust is a type of trust that's set up where the payment is fixed for the life of the trust. And you can't add assets to a charitable remainder annuity trust. The next type of trust that you can add assets to is called a charitable remainder unit trust. This trust also finds that its payments vary each year. The percentage that you get paid on usually stays the same. Say you want 7% a year, but the amount that is paid will vary up and down based on the value of the assets in the charitable remainder trust. So winding down here, communication, we kind of have our corny status ways of saying things here at Ag Country, but communication is either the glue that binds your family or the gunpowder that blows it up. Depending on how you want to use it, if you're good at it, it's work. Good communication is a lot of work. We should know who understands the plan. A lot of people, especially you get around some of these old Norwegians and old Germans, that they're not the greatest communicators. They talk to the table a lot. And so we need to get into their heads and understand their plan. We never want you to make your shop your Las Vegas. You know, what happens there stays there. And of course, if there's expectations, get them on the table, because sooner or later they become assumptions, and we know what assumptions can do to a family. Again, last just a little bit on the family meetings, really important to do, but we also know that some family meetings should not be held because of the family dynamics. But for the most part, they really should be held. The one thing to take off of the last slide is if it's not in writing, excuse me, it does not exist. This is so important, especially when it comes to estate planning. You know, if you tell a child something and 30 years later that changes, you know, that's how it goes. But it needs to be in writing. You know, especially rental agreements. We still work with too many people that don't have rental agreements. Maybe not so important if you've got an entity and you're renting your land to your entity, but maybe, you know, with a neighbor, there should be something in place. So, excuse me, and always remember, time is your friend, no matter what. In our world, if you give us time, we can help you a lot. Sometimes we don't have that luxury, but time is definitely your friend. So, okay.
Thank you, Russ. Very in depth. Well, I got a couple specific questions for you in the
Okay.
Q&A box here.
Sure.
Can a revocable trust gift assets?
Well, a revocable trust is a type of trust you can change. So when you fund a revocable trust, you put the assets in the trust. You don't really gift them. It's just a matter of allowing the trustee, if they have the powers, to distribute certain assets prior to death. Normally, what would occur, Ron, is the assets go into the trust, and then sometime later, the parents decide they want to gift those assets to their children. So we remove those assets from the trust, put them in the names of the trustors, which is usually the parents, and then have them gift it that way.
Another one, on a life estate, does the land get a stepped up basis when the person dies?
Correct. 2032A, 2036A, 2036B. The code is real clear about that. If you have any retention of any ownership right, it's brought back into your estate, gets a step up.
Okay. So there's Russ's contact information, and we're about at our end of our time. I have a couple things to remind you of. All of you will be getting an email telling you the link to the slides and the link to the recording. The recording will be posted in a few days maybe. We also are going to send you the tax updates. Most of you that have been here before We usually get some tax updates, but we kind of slipped through this year, so we'll be sending them to you this week sometime. Also, you will be getting a survey on Qualtrics, so we would appreciate you filling out that survey and telling us what you think about our presentation. We're very happy for you that attended today, and we hope you learned something. And anything else we can do for you, you have our contact information. Just let us know. And thank you to all the presenters, and to Scott Swanson, NDSU IT, and Paul Ann Hawkinson, our great organizer.